We're expecting a growth slowdown pretty much like the rest of Wall Street at this point.
We're not talking about a recession anymore. We're talking about a very soft landing.
It's going to be pretty fine if we're going to be between 1% and 2% GDP growth.
There's so much yield enhancement in this market that it's suppressing volatility, even on the equity level.
We're not in a recession. Look around, the economy is still growing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is CPI Tuesday, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market on the S&P barely positive, 0.1% on the S&P 500. TK 2 hours and 30 minutes away from the big data point of the day.
I think it's a big deal. It's like the auctions last week. It's a big deal. I'm going to look at this. You split it, obviously, core. You adjust for lower gasoline prices. And then will the rest of it all come down? And a lot of heated debate on this. It's going to be a mystery as we go to 8:30.
And then it's on to the Federal Reserve, Tom, where you will hear from Barkin, Barmester, Goolsbee and Jefferson and a whole host of Federal Reserve characters. You looking forward to that?
Yeah, I'm really looking forward to it. I
Good.
like that Goolsbee of Chicago will do it with a sprightly attitude and not too much seriousness, but it's a little bit of over-communication.
You think? Maybe. Getting a ton of outlooks on Wall Street as well. We need to talk about a few of those. I want to talk about this first of all, though. The Bank of America Fund Manager Survey. Listen to some of these highlights. 76% of respondents say the hiking cycle is over, Lisa. 80% expect lower short rates. A record 61% expect lower yields. And just 6%, this is the standout, just 6% see higher CPI in 2024.
This is a big conviction call that bond yields have peaked, inflation has peaked, and from here on out, bonds will do well. What I thought was interesting within this fund manager survey was that investors were throwing away their cash in order to hold the biggest overweight position in bonds going back to 2009. This is a buy the dip moment that we saw really come into effect when that yield hit 5%. Can it continue? Does that conviction last through the CPI print today at 8:30?
Banu Bawaja of UBS is saying, jump on board. Let's buy bonds. Listen to this quote from Banu over at UBS. UBS's outlook here. We don't see the conditions for why this time is so different. Inflation is normalizing quickly, and by the time we get to March, the Fed will be looking at real rates, which are very high. Their outlook, Tom, early 2025, we get back to a one handle on Fed funds. So you've got UBS like right over here and Goldman Sachs somewhere 10 miles down the road.
I got a conviction call. It's just like it was 13 months ago. Go back to look at the certitude of 13 and 12 months ago going into year-end outlooks. I don't think this is any different. People are paid to take an opinion. It makes for good romance and theater with your clients. But other than that, I mean, come on. Somebody will be right. Somebody's going to take a victory
without a
lap
doubt
out there.
But the spread, Tom, the separation between the banks, I think, is the story. We're not coalescing around one view. There is such little visibility about the next 18 months, Bramo, that we've got UBS saying one handle and Goldman Sachs saying back end of 24, maybe you get one rate cut.
This is the initiation of humility on Wall Street after what we got this year, right? Number one. Number two, we don't understand how much weakness there is, and we can go into some of the earnings, but I was just noticing Home Depot Crossing, and one thing that they said was there is pressure on discretionary items. They seem to offer a more tepid view of what's expected in the year ahead, and these types of outlooks, I think, are giving people real pause. We don't know what's in the pipeline with long and variable lags. We don't know what discretionary spending is going to do. And that, I think, is really leading to some of this diversion on Wall Street.
Home Depot in the pre-market up by about 1.2% in early trading. Tomorrow, numbers from Target. After that, we'll get numbers from Walmart. We'll return to those numbers in just a moment. Let's look at the broader price action. Equity futures on the S&P 500 positive here by 0.1%. A little bit of a lift in this equity market. Yesterday, a total snooze across the board to kick off a trading week.
I was watching, got up from the
TK going
surveillance
nowhere.
Me and Vetbill, 2 p.m. were watching, trying to wait for a pop here after 3 p.m. Just
hit snooze. Honestly, yesterday, quiet start to a really busy week. Let's finish on the bond market. Check out the yield curve. We'll fixate our attention on a 10-year maturity. 462 here, Bramo. Yields lower by a couple of basis points.
Yeah, people seem to be piling in. Jim Reed over at Deutsche Bank said this morning, markets have been extremely dull over the past 24 hours, so edifying what you were saying. 8:30 a.m., we do get U.S. CPI. People are looking at core, stripping out energy, given the fact that energy is probably going to disinflate given the declines that we've seen there. The expectation is for 0.3% month-over-month core CPI, which is not great for the Fed. This means it is not going down. It is going in the wrong direction. And at what point does that give some pause to the conviction trade right now on Wall Street? Weighing in on all of that, the Fed speak, and you were mentioning this before, John. Richmond Fed's Tom Barkin at 8:30. Fed Vice Chair for Supervision, Michael Barr, at 10 a.m. Chicago Fed President Austin Goolsbee at 12:45 p.m. Interesting that these are all coming after that CPI print. Do they become a little more hawkish if we do get some sort of upside surprise? And today, as the APEC summit takes place in San Francisco, 9:30 p.m., there is a CEO summit, and this is what I'm watching most of all. Some of the CEOs who are confirmed in attendance: Jane Fraser of Citigroup, Darren Woods of Exxon, Satya Nadella of Microsoft, and Elon Musk of Tesla. There's basically a lot of interest in getting tickets to this dinner with Xi Jinping. The first time Xi Jinping has been in the United States since 2017. Executives are excited.
Now, be clear. You said this is today. There's a meeting, and it's 9:30
p.m. There's just a summit for the CEOs who are going to be attending.
Without President Xi.
Yeah, because that had to happen after the meeting with President Biden, which was the negotiating
tool. Which is tomorrow.
Yes, correct.
Okay, got it.
Is this invite only? Can you buy a ticket? How does this work?
I do believe you cannot buy a ticket.
Wait.
Hold on a second, because
Bramo said it's a ticket. I just wanted to know.
We got to stop the show.
Are you trying to do that? You're trying to get...
Just trying to find out.
Guys,
Just
as we speak, John Ferro's negotiating Pitt Ferrari tickets in Las Vegas. So, John, what you could do is you could go to the Ferrari pit, and before that, you could go to the corporate
We go to
pit.
APEC first, and then we'll make our way to Vegas after that. Okay, so you can't buy a ticket. Let's go to Greg Battle, US Head of Equity and Derivative Strategy over at BNP Paribas. Morning, Greg.
Good morning.
Busy 6 weeks for you. So let's go through the timeline if we can just a little bit. You were looking for a correction, got one. Then you got constructive tactically just for a moment, and now it's fade the rally. Is that right?
Exactly, yeah. The broader narrative has been one where we've been more cautious on the equity market, but we just think that it's a market where you have to be nimble, you have to be reactive. We saw a 10% correction, high to low. We thought the market was oversold, and it left us vulnerable to see a little bit of a reversal. We've seen that, and now we think the right call is to fade the rally again.
Why is that? Why is that the right call right now?
So we think we've seen a correction that's really based on a normalization in terms of rates, a normalization in terms of positioning, and we think the driver from here is more likely to be the bottom-up equity fundamentals, and we think that we're still in a downgrade cycle. And when we look out to 2024 and the bottom-up estimates, to us they look way too high, and one of the takeaways from the Q3 earnings season is that analysts are starting to take those numbers down, and we think we're in a downgrade cycle into the back end of the year, and we think that's going to just weigh on US
Talk about the
markets.
bull call starkly opposite of you in breadth. They're assuming breadth comes on, right?
Yeah. So I think one of the obviously standout features we've seen has been this absolute lack of breadth from equity markets this year. And this recent relief rally that we've seen hasn't really shown any signs of that improving. And when we look back at Q3 earnings season, there's no signs of that breadth improving there either. I think one of the most startling takeaways from Q3 earnings season was the extent of the downgrades further down the market cap spectrum.
I mean, I'm looking at Home Depot coming out in the challenges, and essentially it's a pandemic pop to 400, and then they're churning around 300, and they've basically gone nowhere for a year. That pretty much describes a market in away from the Magnificent Seven, your correct call, and going nowhere.
Yeah, I think it's really hard to see that change because our view is that we are moving into a shallow recession at the start of next year. Whether or not that shallow recession manifests, I think the re-acceleration that's been forecast for some of the more cyclical names when you look at the bottom-up earnings picture isn't going to come through, and that's going to continue to weigh on those stocks. And again, when we look at the outcome of Q3 earnings season, the only names really seeing forecast upgrades post the event were those large cap names linked to AI.
Why won't Fed rate cuts cure all?
So I think if we get Fed rate cuts, they're probably going to get Fed rate cuts for a reason. And if you go and look historically at economic cycles, when the Fed starts cutting, that tends to be a signal to sell rather than buy because they're cutting for a good reason, which is that the macro de-acceleration that everybody's been worried about is finally coming through.
This time is different. That's what everyone seems to be saying, that this time the Fed is going to cut rates, not necessarily in response to dramatic weakness, but simply because rates are going to become that much more restrictive as the economy slows. Why do you push back against that? Why do you expect the weakness to be more significant in certain pockets?
I really think it's just a question of what history tells us. The Fed tends to cut when they have to, and that tends to be a response to this deacceleration in data. When we go from a Goldilocks environment into one in which data slows, it doesn't tend to slow in an orderly way. I think the labor market is the best thing to look at here. It's very unusual to see unemployment just slowly pick up and a healthy amount of slack just emerge in the labor market. What you tend to get is something far more disorderly. When the Fed starts to get slack in the labor market, it's going to have to be a little bit careful what it wishes for.
This has been a really confusing economic cycle and a really confusing market cycle for a host of reasons, and not least of which is just that each industry seems to be moving at a different pace, at a different cycle economically. Could you see an area where suddenly even some of the small caps, which already are doing really poorly, could continue to get beaten up even as big tech continues to rally based on the fact that they can consolidate market share regardless of the market cycle?
Well, that's essentially one of the things that we've seen in this cycle. There is this kind of relative size advantage, and it also comes a relative balance sheet advantage. The biggest stocks are also those that have the best free cash flow profiles and the strongest balance sheet. So there's this relative effect of rates that it bites far further down the market cap spectrum. So if we do move into a kind of softening in terms of the macro data, it's unlikely that that's going to do much to narrow the breadth. Although our view is that if we do see a more significant economic deacceleration, it is something that could drive more correlation, and ultimately higher correlation is what we need to see if we are to get a pickup in equity vol.
Can we pick a sector? Let's talk about the banks. Banks didn't work with really good growth and higher rates. They work with less good growth and lower rates.
I think banks are challenging. I mean, my views are somewhat scarred from having been in Europe over the last couple of decades, and you do see the effect of the risk the sector becomes a value trap. When we look at equities this year, chasing the cheapest stocks certainly hasn't been a trade that has worked. I think there's undoubtedly value to be found in the banking sector, but the question is, if we are moving into a deterioration in terms of the macroeconomic outlook, is this the right time to be stepping into the banks? I would say no.
We're both conditioned by this, the European experience. Do you think US regionals could start to look like what's plagued Europe over the last 10 years?
I think in some respects they already do, which is that I think that they've become something of a value trap. So it's not obvious to me what is the catalyst outside of a kind of Goldilocks, very positive, super risk-on environment next year that's going to break us out of that.
What the heart of the matter here is the growthiness of the big tech companies. All sorts of institutions in retail who've guessed right on that are loving 2023. You're saying we stay delinked in 2024. That's the heart of the matter. You don't really care what Apple does, do you?
I mean, I do a little bit, and I think there's actually differentiation between the large cap tech. One of the things that we've been saying is look to chase specific themes. So we think that AI and consumer are two kind of polar opposite themes. And when we look at the large cap tech, there are some of those names, such as Apple, which is a slightly more consumer facing stock. So we do think that even within the mega caps, there is this potential for rotation, and those stocks that are more exposed to the consumer, even if they are large cap quality cash generative stocks, we think could suffer a little bit more if we see the economy tip into recession.
Greg, thank you, sir. It's good to see you.
Thank you.
Greg Battle of BNP Paribas, very active over the last 6 weeks or so. I promised you we'd return to Home Depot, so let's talk about those numbers. Still looking for a decline in revenue. Just narrowing the guidance, just a touch. So this is the outlook now for full year sales, -3% to -4%. Had seen -2% to -5% previously. We'll do the same for EPS as well. EPS growth full year, this is the guidance now, -9% to down 11%. The previous range, Lisa, down 7 to down 13.
And they talked about how there's ongoing pressure on big ticket discretionary categories, and this really speaks to this question of the disposable income that people have with respect to savings. It also highlights, as you look through the numbers, how much inflation's helping them. Basically, their sales volume is going down, but their overall sales revenue is staying about the same, partly because costs have just gone up for each of those items.
This week is a massive week for the consumer. For the consumer in America, how far can a dollar go? We'll get inflation a little bit later this morning. We'll get some insight to the consumer from retailers all week. Home Depot this morning, Target tomorrow, then on to Walmart. And then we'll get jobless claims Thursday morning. The same morning we get Walmart numbers. So a lot to look ahead to, including retail sales, that big data point just after CPI today. Equity futures just about unchanged from New York City this morning. Good morning.
With regard to a potential shutdown, I understand that the new Speaker of the House has a proposal. It's being negotiated with the Minority Leader of the House, and Senator Schumer and the Republican leader are also talking about it. I don't know what the outcome is going to be.
The President of the United States reluctant to prejudge the outcome of this week's talks in Congress. The House planning to vote today on Speaker Mike Johnson's temporary funding proposal to avert a shutdown. Greg Valliere of AGF Investments writing the following. In a bit of a surprise, Democrats are leaning towards accepting the proposal. Odds are roughly 60-40 that a budget deal can prevail in the next few days, but the bill will have one glaring omission. Tom, there is no funding for Israel and Ukraine, which may not pass until early next year.
This is really, really important, John. I think you're more read up on this. Why don't you bring in Greg Valliere this morning? But the partition here between Israel and Ukraine, these are two different studies, two different conversations.
Greg Valliere joins us right now, the Chief US Policy Strategist at AGF Investments. Greg, in your mind, from your perspective, in your opinion, do you think this can get through Congress this week?
I think they can. It's been so humiliating for them for the last few weeks. I think they know they've got to do something. The credit rating downgrade is serious. So, yeah, I'm at 60-40. I mean, it's possible that a handful of far-right radical Republicans could kill this. But I think they want to give, at least on this first bill, they want to give Mike Johnson a victory.
This is what I was going to ask, Greg. Who does this particular offer upset more? Is it Republicans within his own party or elsewhere?
Well, it's a good point, John. There's so much in the bill to hate. For the conservative Republicans, there are no spending cuts, and they're quite upset over that. For the White House and the Democrats, the fact that there's nothing for Israel or Ukraine is very troubling. And we can say, oh, we'll get them some money in February. Well, they need money now, and I think to not send our allies this money sends a very bad signal.
Greg, it's that time of year. Our Greg Giroux owns a high ground on keeping track of who's leaving, who's coming, who's going in the House and the Senate. Juan Williams in the Hill today, or yesterday, I should say, really writes it up of the Republicans leaving the House. I think this is underreported. You've got Buck, you've got Granger, you've got Lesko, you've got Spartz, on and on. Is this going to be even a more Trump Republican Party, not in a year, but in a matter of weeks?
It could be, yes. And a lot of the names you mentioned are people who are disgusted. They can't take it anymore. I also think there's a growing chance, a very good chance, that the next Senate will elect a year from now will be controlled by the Republicans. They have, I think, an easy chance to take the Senate.
You know, I look at this as wildly underreported. You know, the focus on Manchin and that in Spanberger, Virginia. Have you seen it like this before? Is this normal changing of the chairs, musical chairs, or is there something unique here?
Well, I tell you, Tom, I think what is unusual is to have Democrats talking now openly about a need to get a different nominee. That's really unprecedented. You probably have to go back to LBJ, who lost support in his own party. That makes the Democrats nervous, the fact that they could lose the Senate and lose it convincingly.
We'll get back to that in 1 second because I do want to get your view on that. But just to build on what you're talking about, the fact that Democrats are joining with Republicans, some of them, to back Mike Johnson's plan. Isn't this what got Kevin McCarthy ousted as House Speaker?
Bingo. That's right. And I got to think that we could have a repeat. You only need like 3 or 4, at the most 5 no votes, and this whole thing could fall apart. So I think that Johnson has to worry that he could suffer the exact same fate as Kevin McCarthy.
And there still are at least 9 ultra-conservatives in his party who are going to vote against this, at least as for now. What's worse, though, on an international stage? You were talking about no funding for Ukraine and Israel. Is that worse than a government shutdown in the U.S.?
I think a government shutdown is become so ordinary. A brief shutdown wouldn't be as serious as sending a signal to our allies that we can't support them. I mean, this, I think, is really very, very unnerving. One other point I'd make quickly. I do think the final outcome is Johnson having to cut a deal with Democrats. I think that's the only way we're going to get a deal in the next week or two, is to have the two parties unite on this.
What will be the ramifications of that? I call that doing a John Boehner for our international audience. We've seen this before. But then what is the outcome if he does that?
the outcome is going to be an effort to oust him. I still think it's less than 50-50. I think they want to give him a victory, Tom, but you could see a lot of Republicans say this is totally unacceptable.
Greg, let's talk about the race for the presidency next year. Yeah. The field is narrowing on the Republican side, and it looks like Nikki Haley's starting to attract some money. What do you make of the moves we've seen in the past week, Greg?
Well, Tim Scott didn't surprise me in the least. I think that the strongest, other than Trump, of course, has been Nikki Haley over the last few weeks. She's got real momentum. DeSantis does not. He didn't even mention his endorsement in Iowa from the governor. I can't figure
Greg,
out.
That was so weird. Can I just jump in? What was that about? Yeah. Why didn't that come up in the debate?
I don't get it. She endorsed him. I'd be bragging about it, but he didn't even bring it up in the debate. That was mystifying. But it's still Trump's to lose. Trump has said some extraordinary things in the last few days about how his opponents are vermin, using really, even by his standards, exceptionally harsh language. But his numbers hold up. He still has the base.
And that means we need to narrow the field potentially even more for the Republicans. Who's next to drop out, Greg?
Maybe Ramaswamy. He's got money, but I could see him drop out. He's got no traction. His numbers don't look good. I think DeSantis and Nikki Haley stay in, and probably Chris Christie stays in, and that's good theater.
Well, at this point, maybe the field is narrowing on the Republican side, but in some ways it's actually widening on the Democratic side. You said that there's real fear and there are real calls within the Democratic Party to have some other options than President Biden. How realistic is that? Who is everyone coalescing around?
Well, that's the problem. Nobody. And I think one of the strongest things that Biden has is the lack of any clear successor. And I think because of that, he will be the nominee. Apparently, in the last 24 hours, he's been very angry, profane, criticizing people like David Axelrod. I think he feels that he should be the nominee. I think he will be the nominee.
What do you think he's upset about, Greg?
Oh, mocking him for his age, probably more than anything else. You can't do much about that.
That's true. Greg Valliere of AGF Investments. Don't think any of us can do anything about that, Greg. Appreciate the updates. To Bramo's point, TK, that question just won't go away for this president. I can see why it annoys him, but ultimately it's a question being asked within his own party, not externally, not outside of it.
And it's percolating for the former president as well. I'm not up to speed on the exact anecdotes, but people are a bit mystified by misstatements by President Trump and President Biden. It's equal opportunity.
Well, and then you have all these independent potential candidates, and who does that hurt more? And that raises this question of, can we actually get a viable independent candidate? A lot of people say it's never happened before. It doesn't usually work that way, and it's just a matter of whose votes they cannibalize more, the Democrats or the Republicans.
I just want to point out, John, this word vermin, and it's a really Merriam-Webster. It's an ugly term, and there's really been some serious
it's a loaded term,
criticism, noxious, objectionable, or disgusting. And what's so tragic here, and John, probably in your depleted English childhood, you missed that. What the president could have done is gone for the Southern vote and gone all Yosemite Sam on us and said something like, "Why, you no good varmint." That's a famous Disney line.
You might need to tell me more about my depleted childhood.
That's a Warner Brothers line there. Do you know who Yosemite Sam is?
No.
Okay, Warner Brothers. And if President Trump had gone in there with a Yosemite Sam riff, he would have scored major Southern electoral
You lost
success.
me at depleted childhood, to be
honest.
honest.
Bugs Bunny. It's an offshoot of Bugs Bunny.
Okay,
Go
good to know. Thank you.
Coyote over the cliff.
All right, and it sort of stands there with the legs racing. Yeah. Okay.
Say your prayers.
I still don't know where this is going. Coming up, Julia Coronado of Macro Policy Perspective joining us very shortly. It's a big week ahead for economic data. The week begins this morning. Inflation data about 2 hours away. Then on to tomorrow morning, you'll get retail sales in America. In between, tons of Fed speak. You'll hear from whatever Fed official you want to hear from. Who's your favourite? You'll hear from them later this week. Do you have a favourite, Brahma?
Yeah, I have a couple favourites.
Do you?
We're not going to speak for today.
Oh, you have favourites?
There's some people who actually say something, and then there's some people who don't, but they keep speaking.
Do you want to tell us which one that is?
No, I don't.
All right. Maybe people can guess. Equity futures on the S&P, just about positive. Live from New York City this morning. Good morning. What a snooze. A start to a very busy week, a quiet start to a very, very busy week in this equity market. Your equity market right now looks like this on the S&P. We're going absolutely nowhere, up 0.04% on the S&P 500. Quiet start to what is really a very busy week. We'll be talking about CPI throughout this morning. That data about 2 hours away. Looking at the bond market, the 2-year, 10-year, 30-year shaping up as follows. The 10-year yield down a couple of basis points, 461.81 on a 10-year. The 2-year, just north of 5%, 5.03% on a 2-year this morning. Just to finish on foreign exchange, quick sneak peek of what's happening in the euro, climbing for a second session yesterday, up again today, 3 days against 107.19 on the euro against the dollar. There's your price action, Bramo, 0.2%.
I'm just so impressed. We've got 107. This is exciting times in the Euroland.
It's all happening.
Yeah.
I mean, I'm joking. It does get more interesting as the week progresses, I promise you. CPI, 2 hours away. Looking ahead to that inflation data, the median estimate in Bloomberg survey calling for a headline CPI read of 3.3%, down from September's 3.7. Wall Street's biggest banks estimating a 0.3% rise in core CPI month over month. Bramo, does the disinflationary story start to stall going into year end?
If we get this kind of print as expected, yes. And this is a problem. It's moving in the wrong direction. We're not getting the disinflation that people expected. You dig into the technicals, and it's because of healthcare reevaluation of exactly how they price inflation with all of your expenses from medical bills, which we all know are going up pretty dramatically. Here's the question to me is, how does the market respond? What's the potential bigger disruption in markets, an upside surprise or a downside surprise, given that everyone seems to be clamoring in on a bond bet? And this might just give them the all clear if we underwhelm with the inflation.
Citi's Andrew Honhorst says it doesn't really matter how big the upside surprise is, Tom, that ultimately this bar is so high now for another hike from the Federal Reserve going into year end. Maybe this doesn't matter as much as it used to.
Yeah, I'll go with that. I think it's at a critical point here, and I'm not really sure which to focus on at 8:30. Do we look at the non-gasoline, non-oil reduced numbers of the actual all-in pie? I'm going to do what David Rosenberg would do, which is just tear it apart. And there's going to be a lot of deflationary goods and even maybe some deflationary service sector trends there.
All of that 2 hours away. Let's get to the next story. On Capitol Hill, the House expecting to vote on Speaker Johnson's plan to avoid a government shutdown. The bill would fund federal agencies into early next year while avoiding a debate over funding for Ukraine and Israel. The Democratic-controlled Senate open to accepting the deal as long as there are no deep cuts to federal spending. Lisa, this would set up a fight later on because ultimately there is going to be a push for big cuts to federal spending, particularly given what we heard from the likes of Moody's going into the weekend.
So hear that can just being kicked down the road. This
Without
is essentially what it is every single time. What I find interesting, this is from Punchbowl, and it really crystallizes the issue to me. The fact that Johnson needs Democrats to pass his first major piece of legislation undermines the central tenet of his speakership, that the Louisiana Republican is decidedly more conservative than his predecessors and would govern that way. To me, this highlights how dysfunctional we have gotten. There are still at least 9 hardliner Republicans who are not going to get on Mike Johnson's train, even though he was elected with the express purpose of being more conservative than Kevin McCarthy.
So this speaks to the governance issues, Tom, that Moody's was reflecting on going into the weekend. The other big issue, of course, and it's not going anywhere, the debt pile, the amount of spending, the size of the deficit. These are things Republicans are going to try and deal with going into year end.
I would distill it. For people that don't follow this topic, it's real simple. The annual interest bill and percolating out there is this year, next year, the year following, the annual interest bill that the household known as the United States of America will be the biggest line item they have. That's, I don't care what your politics is, that's a new moment.
Tom, it's been a failure of successive governments to deal with it. And we had a big disruption in between, as you know, the pandemic, which just blew out the government deficit. It's something that we're still struggling to get under control.
And my key thing here, as Julia Coronado knows, is called is R minus G. And all of a sudden, G has always been, we're always going to sustain G. Stiglitz has said this, we're going to sustain G so we don't need to care about R. All of a sudden, is G going to be there, the little growth rate? And then the real rate, R, is a critical attribute right now.
Looking forward to Julia's thoughts on some of these stories in just a moment. Let's finish on this. An update on ICBC.
This won't go away.
Officials from China in the United States looking to clean up the hack, which froze the world's largest bank last week. Normal service has yet to be restored after a ransomware attack from a group named Lockbit forced the bank to settle trades through a USB stick carried across Manhattan. Just an unbelievable story. Lisa, Bloomberg reporting it may take weeks to settle all security issues and clear transactions.
The fact that it hasn't been resolved, what are they negotiating? How much they're going to pay the ransomware, the hackers that are accused of doing this? The idea in in this sort of recent update that we've gotten, ICBC held discussions about hiring a Google-owned cybersecurity firm. They're still holding discussions about how to clean this up, which just highlights how far away we are from some sort of resolution.
May I suggest a story we're all going to read in many different papers, including Bloomberg News' wonderful finance team, this is U.S. government banking supervision authorities talking to a foreign bank with a foreign culture that's not used to be talking to authorities like that. That's going on right now, I would guess.
Zooming out, there has been this feeling that at the major U.S. banks, there has been a serious investment in cybersecurity, perhaps more so than ICBC and some of the Chinese banks. So is there going to be some sort of standard that U.S. regulators, to your point, try to uphold about spending or cybersecurity protection? How do you even mandate something like that, though?
I think there's a feeling the real worry, Lisa, is this could happen to anyone. Any bank. Right. It just so happened it happened to ICBC. This is something banks have feared, Tom, for a long time now.
Is it just, it's not that it's a China bank or a foreign bank. Is it random that it happened to them? I don't buy it.
I'd be guessing if I gave you my assessment with any confidence, Tom. But I think ultimately this is something the whole industry has been warning about for years now.
Absolutely. And we'll see that, of course, into the decade as well. Joining us now, Julia Coronado, equity strategist at Macro Policy Perspectives. Julia, I want to congratulate you for getting out front of all the stock market outlooks that we're seeing this year. You say the key determinant in what we're doing is a new productivity. There's a complete mystery to the new service sector, what it means for long and variable lags in your wonderful economics, but it's how you get to the optimism of Edward Yardeni, Yale economist and wonderful equity guy. Does your productivity call lead you to a better stock market because we're just more efficient than we ever thought?
Well, so I'm not a bottoms-up stock analyst, but generally speaking, I think that's the direction of travel. That if you look at, say, analyst expectations for 2024, you've got very middling, mid-single-digit revenue growth, but pretty healthy margin expansion. That relies on a broad-based improvement in productivity, and that is, in fact, the same recipe that has delivered a cooling in inflation and resilient economic growth this year. So I do have some optimism it can continue. It is going to be battling long and variable lags, so we don't think that we're in for a boom time in 2024, but we do think that the resilience we've seen can hang on.
Lisa, I think this is critical. My theme for last year, this year, is the Great Zombie Roll-Up. I don't have a theme yet for 2024, but it's ramped around this complete, total mystery between Greg Bottle, BNP Paribas with caution, and the Uber bulls who agree with Dr. Coronado that there's a more productive service sector out there than we ever imagined.
And later this year, we will get the theme for 2024 from Tom Keene. Julia Coronado.
Could be with it by the end of the show.
Maybe by the end of the show. Julia Coronado, I am curious, though, about some of the vagaries around the political dysfunction that people keep talking about. It's what Moody's really used as one of their main reasons to downgrade the U.S. to on watch for downgrade from that AAA rating. Janet Yellen, Treasury Secretary, said yesterday in San Francisco that she disagrees with this action and that the American economy is fundamentally strong and Treasury securities remain the world's preeminent safe and liquid asset. Do you agree with certainty that we can say that?
That the treasuries will retain their status? I mean, I think the dollar is quite strong. There isn't any hesitation to hold dollar assets. So I don't think we're in imminent danger of losing that status. I do think that there's, a higher price that investors demand to hold bonds, and the landscape of bond buyers has certainly shifted with the Fed doing QT, with banks selling securities, with international shifts in demand. We certainly have seen more price sensitivity for bond buying. I don't think that's a broader dollar question. I do agree that the dysfunction within the government is not good. We certainly are testing the resilience of the dollar's status with a lot of mishandling of some basic functions. And it seems to be a repeated thing it's going to be with us, through 2024. We're going into an election year. And election years bring their own headwind through uncertainty because the choices are pretty wildly different. And so, formulating outlooks and allocating investment and capital is pretty difficult in an election year, and so that's going to be an ongoing challenge.
One of the most interesting aspects of a lot of the economics reports I've been reading recently have to do with where the fiscal impulse begins and where it ends. A lot of people saying that one of the surprises in 2023 was just how much fiscal impulse was still pumping into the system, and that was going to go away, start coming early 2024, and that would lead to a slowdown in tandem with the bite of higher rates. Do you agree with that people are underestimating the fiscal drag that we're going to experience next year?
No, I actually go the other direction. Keep in mind that 2/3 of government spending happens at the state and local level. They're getting a lot of transfers through the infrastructure bills and the IRA. But in addition to that, they're experiencing a property tax boom. They're experiencing the mirror image of last cycle, where their revenues were down. State and local governments were dragging down GDP by several tenths every quarter for 5 years early last cycle. We've got the reverse now. Most of the fiscal impulse, or it's about evenly split between federal and state and local. And I think there's still some gas in the tank. We've got both state and local governments flush with cash, and these long-tailed legislation from the federal government. These investment bills that money isn't all spent. So we might get some fading in 2024, but at the state and local level, I don't see any pullback on the horizon.
Julia, you blend the academics with the market economics. Help me here, John. I got a 4.1% statistic year over year on core inflation. What's the difference between 4.1 and 3.9? Emotionally, that's got to be a huge deal if and when we print a 3.9.
Oh, yes. I think, each of these, the handle at the beginning is going to matter. Once we go below 3, imagine that. That will be quite a victory. But I think the direction of travel is very important. For the Fed, again, yes, the bar is high for another hike. At the same time, they're going to want to hold on to that option as long as we are not making progress. Whereas as we continue to make progress, you will see them gradually step back from that threat. And that will be very meaningful for longer-term interest rates and spreads, in particular mortgages. We're still at all-time wides on spreads. That's locking up the housing market. If we could get some action there, that would be pretty important.
John, United Kingdom from 6.7 CPI, core CPI 6.1 down to 5.8. That differential is just shocking.
Julia's right. Direction's important here. The question for a lot of people on the street now, Tom, are we converging towards 3 or converging towards 2?
Yeah.
And what will the difference be for policy ultimately through 2024? Julia, appreciate the update. It's always wonderful to hear from you. Julia Coronado there of Macro Policy Perspectives. Bramo, Julia's right. Secretary Yellen's right. But just because Secretary Yellen is right does not mean there isn't a problem. And this is the issue, and I think Julia spoke to it, that we're going to have to pay more to finance this deficit. And ultimately, we are.
And that's really clear by the fact that interest rates doubled from one year to the next, this year, to $1 trillion, and will only continue going upward. We're just beginning, and we're starting to see some of those tallies. Here's a question that we don't understand, and maybe we'll get some better sense of it on Friday with the government shutdown or not, is just how much that's actually affecting where yields are. We don't know.
We haven't lost the privilege of acting recklessly, but we're losing it. It's an important difference. Jeremy Stretch of CIBC is going to join us shortly. Your equity market on the S&P just about positive going into inflation a few hours away. From New York City, this is Bloomberg.
We're probably going to get core PC inflation below 3% by the second quarter of next year. It's not like we're talking about, sometime in 2025. We're talking about in 1 or 2 or 1.5 quarters. And suddenly, perhaps, real rate, the real federal funds rate is then going to be way, way, way too restrictive. And then the market and the Fed can start talking about rate cuts. You're actually going to continue seeing a pretty Goldilocks-y environment.
What is a Goldilocksy environment?
Not a lot.
Call Max Kettner of HSBC. He'll tell you. He says Goldilocks is back. Welcome back. Thank you for joining us. Your equity market on the S&P positive by 0.1%. Here are the scores going into CPI in America. The 10-year yield lower by a couple of basis points, 4.6142 on a 10-year maturity. In the FX market, the dollar just a touch weaker, euro stronger. Tom, for a third day, the euro positive here by 0.2%, 107.21.
Lots to talk here on FX. Euro 107. Lots going on, and with Jeremy Stretch coming up, that's important. John, I'm sorry. I was looking up Goldilocks. I didn't know she was an intern at Morgan Stanley a few years ago. Worked with Steve Roach.
Is Goldilocks right in the outlook now?
Yeah, she had to deal with Steve Roach.
She grew up.
She's looking for a soft landing.
She's all soft landing, I think.
Okay.
I'm hearing way too much Goldilocks. That's like V-shaped. What's this about?
It means something different to different people. I remember when a soft landing was just below trend growth without a recession. Isn't that, Bramo, what a soft landing was? Isn't that what it is?
Well, now people are adjusting that, redefining it as simply a shallow recession is a soft landing. Anything is a soft landing that isn't a bigger than expected recession, essentially.
Okay.
That's my sense.
So the unemployment call within that, I think that was the key differentiating factor in the outlooks. We were looking at Morgan Stanley versus Goldman Sachs. The outlook for unemployment.
Yes,
Goldman has still got it
that.
low going into 2024. With inflation getting back to target and the Federal Reserve not cutting.
This goes right back to Julia Coronado and his arch call on American productivity. The fact is, everybody's been wrong on a failed job economy in 2023, and there's something John, it's a mystery. Nobody here has an answer as to this machine of labor known as the American economy.
Things are starting to change. The data's starting to shift just a little bit in the labour market.
No question about it.
Deutsche Bank going as far as saying that the data remains broadly consistent with end-of-cycle dynamics. Whether you agree with them is your judgment. That is up to you. But, Tom, we're starting to see that shift. Claims starting to move out just a touch. It's so subtle. Delinquency starting to rise. This is why this week, by the way, is so important. You've got retail sales, you've got CPI, you've got all the retailers reporting as well. Are we starting to see that slowdown arrive in 4Q, or is it still too soon?
And there's going to be managed cost cutting among those ginormous retailers. Again, we forget the size. I mentioned Home Depot. I think it's 400,000. Let me look up Walmart right now. You can do this on the Bloomberg Professional Service. Walmart, 2.1 million employees. I did not know that. That's
not just about the employees, but also the people shopping there as well. Yeah. They've been talking about trade down for so many quarters now, Tom, attracting customers from elsewhere.
Can you imagine their summer party?
At Walmart?
At Walmart, 2.1 million.
Is that a festival? I think that's a festival, isn't it?
It's a festival. It's like Woodstock.
Like Burning Man.
They show up. It's fascinating.
I can see you at Burning Man.
Yeah, I'm very Burning Man.
Burning Man.
Totally. Yeah, like in a really
suit and a bow tie.
Special bow tie.
Blowing fire.
All right, in a really nice RV.
I can see that. That works for you.
Luxurious RV.
You should do Burning Man next year.
Can we get the countdown clock up here on radio? You are so lucky on radio that you don't have the CPI countdown clock.
In the mud.
I mean, radio deserves their own countdown clock. We've got one. It's somewhere. It's lost in the control room somewhere. Right now, saving us, Jeremy Stretch. He is international strategist, chief international strategist at CIBC. Jeremy, I'm going to do an audible here.
Good morning, Tom.
On the inflation that's out there on this inflation day. And I look at Japan is the worst offender with a 5% plus nominal GDP and a national CPI of a stunning 3.3%. If and when Japan disinflates, what's it mean for our inflation? What's it mean for our listeners and viewers in the West?
Well, I think you've raised an interesting point there, and I think that's one of the variables that we've been trying to rationalize and deal with over the course of the last decade or so is the impact of goods price deflation or exporting of disinflationary pressures from both Japan and to an extent over the period in China as well. So if we do see a gradual reversal of that negative inflation dynamic in Japan, which I think is still a story for 2024, if we do see wage growth picking up, then that may have a little bit further of an inflationary impulse for global markets in terms of global goods prices. But I think it is still this broad sort of generalized moderation in price pressures that we will see over the course of the next few weeks and months. The question is, how long does it take to get back to that 2% inflation threshold? And I think in that context, we have to have patience because it does still feel more likely it's going to be nearer 2025 than it is in 2024.
What do you hope to learn from the 8:30 inflation report this morning?
Well, I think obviously we will be looking to see the path of the trend in terms of core prices and to see whether that 4% threshold can be breached. I think there is an obvious significance in terms of breaking down through some key significant levels. We will be looking for the sub-indices in particular in relation to things like the rental market to see how that is playing out, to see how the lagged impact of this policy tightening is playing out. Because, of course, there is still that obvious inference that we've seen this aggressive degree of policy tightening, not just from the Fed, but in pretty much all global markets ex-Japan. And yet we haven't seen an opportunity for the central banks to identify how their policy mechanisms are playing out. And that sort of plays into the Friedman fall in the shower narrative, that there is still this risk that policymakers are still very mindful of, still thinking about the possibility of some cases turning up the dial, and what would that do to the policy narrative in view of the obvious policy lags.
And for now, though, the narrative does seem to have shifted yet again this year, probably the 432nd time this year. But there is this question now of just how much people are set up and prepared for us to have seen the peak in yields, the peak in inflation. And is the bigger surprise, and this is my question to you, Jeremy, is the bigger surprise for markets derived from this print, if it's an upside surprise or a downside surprise, if the inflation read comes in hotter than expected or weaker than expected, which would generate the bigger response in markets?
Well, I think there's certainly been some whisper rumors that perhaps the risks are more to the upside. I think it's interesting when you look at the Michigan inflation expectations components from last Friday. We did see a significant uptick in both the one-year and the long-term inflation dynamics. Now, that perhaps is a reflection of the spike that we saw in gas prices back in October, and that hasn't perhaps dropped out of the system yet. But I think there is more of a risk in terms of a top-side surprise as far as today is concerned. We're still very mindful that there is a residual risk of the Fed still having one further hike in it, and I think the Fed will be very keen to maintain that policy optionality in the context of the inflation backdrop. So I think in terms of December or January OIS pricing, I think there is scope for a little bit of an uptick, and I think that's the sort of the narrative that I would be very mindful of going into today's print.
And what does that mean for the dollar?
Well, if we do see those repricing of expectations, so we're only pricing them at 4 or 5 beats for December currently, and if we do see just a gentle but progressive uptick in terms of those expectations, then I think that should provide some dollar resilience. You've already talked about the euro looking a little better bid this morning, but I think I'd still prefer to be selling euro rallies up to the sort of 107.5 level, because I still think there is a degree of skepticism regarding the euro recovery narrative. And I think that would provide resilience in both the DXY and the broader Bloomberg DXY indices over the course of the next few sessions.
Jeremy, thank you for your view going into next year. Jeremy Stretch there of CIBC. On the dollar, here's a guy that agrees with him. We talked about Max Kettner over at HSBC. Here's the Fed view. First cut, Q3 2024. Here's the Treasury view. It's likely the next 100 to 150 basis point move in yields is down and not up. Here's the dollar view. We expect the dollar to remain strong in 2024, aided by soft global growth, Lisa, and comparatively higher yields in the United States.
This is what I find interesting. Max Kettner was talking about Goldilocks, and Goldilocks includes fewer rate cuts than some of his compatriots over at UBS. This is calling for more strength, but just enough weakness to give that little bit of a confidence to the Fed to cut rates just a little bit.
It sounds
next
like a
year.
recipe. Doesn't it, right?
We've got a lot of recipes in this show.
The cooking channel.
Exactly.
On this show. Coming up, more on that. Stuart Kaiser of Citi is going to join us on the equity market. Whether to be constructive, Tom, going into year end.
Well, it's good to have Stuart Kaiser. He's been absolutely dead on about you got to participate in the market. That's half the battle. Can you believe the wides of BNP Paribas and Yardeni Research? Wow. It's
spread
like
between the two.
1,500 SPX points. On the break, I'll do the math on that and what that means in equivalent Dow Jones Industrial Average points.
At this point, if we ask the question, is there a consensus for 2024? I think it's fair to say right now there isn't one.
It's going to keep us employed on Bloomberg surveillance.
I heard someone say Dow points. I'm just choosing to ignore them. Stuart Kaiser of Citi, coming up next.
We're expecting a growth slowdown pretty much like the rest of Wall Street at this point.
We're not talking about a recession anymore. We're talking about a very soft landing.
It's going to be pretty fine if we're going to be between 1% and 2% GDP growth.
There's so much yield enhancement in this market that it's suppressing volatility, even on the equity level.
We're not in a recession. Look around, the economy is still growing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Your trading week begins this morning, live from New York City. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Your equity market positive by 0.1% on the S&P 500. 90 minutes away, TK, from U.S. inflation.
The inflation report critical, and I'm going to go to the 10-year yield just simply as the benchmark off of a difficult auction last week. Thank you, Bramo, for that. The two standard deviation study, the trading envelope, John, is going to bring that yield down to 4.46% if you get a move within a trend. Right now, in 2 basis points, 4.62%. That gives you an idea of the potential we could have of an 8:30 shock.
We've got to do a few things this morning. You take the economic data, push it through the Federal Reserve, what does it mean for them, work out what it means for financial markets, and then get to politics. This from Politico this morning, some private polling presented to the White House in mid-September and recently obtained by Politico. 7 out of 10 people surveyed believed the economy wasn't getting better. Lisa, even after they were told explicitly that inflation had eased and unemployment was near record lows. Bidenomics is not breaking through.
Here's a comment from one of the members of the campaign staff. When we intentionally put our finger on the scale and 100% of people hear good economic indicators before saying if the economy is going well for them, we still get walloped. That frustration endemic in some of these comments that it doesn't matter what the facts are on the ground. People are not feeling good, and that's being reflected in President Biden's poll numbers.
Is that going to change 12 months from now? Where are we going to land? I don't know. Where do people think we're going to land? The fund manager survey out of B of A, worth going through again, Tom. 76% say the hiking cycle is over. 61%, that's a record in this survey, expecting lower yields from here. And just 6% see higher CPI in 2024. A lot of people writing in about that, Tom. Maybe that could be the pain trade next year. If just 6% think CPI will be higher next year.
The pain trade to me is what does incomes do? And, you know, we've seen this with the view of what is cumulative inflation back to 2019. Nobody's going to talk about that at 8:30 this morning. 110% of our audience is living the cumulative inflation rate because incomes for many people, not all, have really not kept up.
You see that in consumer sentiment, Tom.
Yeah.
They don't feel good right now. We'll find out what they're doing. We'll get retail sales tomorrow morning. Then we'll hear from the retailers throughout today. We've had Home Depot. Tomorrow we'll get Target. After that, we'll hear from Walmart as well. So a decent snapshot of retailers in America coming up over the next 48 hours or so. Here's a snapshot of financial markets at the moment. Equity's just about positive on the S&P by 0.1%. Yields dropping, pulling back by 2 basis points here on a 10-year maturity, Lisa, 462.21. And the euro just a little stronger, dollar weaker here. Euro dollar, 107.19.
You just said something, and I want to sit on that when we look forward to U.S. CPI, which is the biggest pain trade next year, may be that we don't see a massive disinflation. At 8:30 a.m., we get U.S. CPI, and it is not going to show a massive disinflation, at least when you strip out energy and food. You can actually see that stickiness, that coming down to 3 to 4% inflation in the U.S. on an average annualized basis, not the 2% that the Fed wants, 0.3% month-over-month expectation, moving in the wrong direction. Is this idiosyncratic, having to do with healthcare issues, et cetera? That's what we're going to be talking about in about 90 minutes' time. Today, Fed speakers will also address this, whether they give insight. We shall see. Richmond Fed's Tom Barkin at 8:30 a.m. Bang, counter-programming. Maybe he could do a real-time live commentary on the CPI report. Fed Vice Chair Michael Barr at 10 a.m. Chicago Fed President Austin Goolsbee at 12:45 p.m. How much has their rhetoric underscored this new consensus in the market that bonds are a good bet, that the Fed is done, and that the next move is going to be a rate cut, and that they're really setting the bar much higher to raise rates yet again? And today, we're looking at San Francisco, and not just because they cleaned it up for the APEC summit, but also because the CEOs
That's
are
exactly
landing.
why I'm looking at
I know you are. I know you are. And actually, you're right, too, and we could talk about that later.
Sure.
Because that actually is a big issue for a lot of cities, and in that one in particular. But 9:30 p.m., there's a CEO summit, a welcome reception. And I'm actually really interested to see who shows up. The confirmed guests that we know so far, Citigroup's CEO Jane Fraser, Darren Woods of Exxon, Satya Nadella, the Microsoft CEO, Elon Musk, not a big surprise of Tesla given how much business they do in China. The coveted seats at the dinner to be had with Xi Jinping. Very interesting to watch to see whether they get the confidence they're looking for to possibly reignite their effort in the world's second biggest economy.
I said this yesterday. Can she come to New York? Just help Eric Adams clean things up a little bit.
What do you want to see most of all?
Honestly, it's amazing to me. Okay, look, I know everyone does this. I know everyone does this. Pick a city, pick a country. Whenever they host an event like this is what they do. But doesn't it speak to ability and not willingness? They can do this. Why haven't they been doing it for the last several years?
It's a good question. I wish I had an answer for you. I wish that we weren't getting used to things like stains of garbage on the ground and sort of rats and all of that. And I don't think anyone needs to be hearing this. It's breakfast time. Good morning. I
saw a picture of CVS and they're now putting pictures of toilet rolls on the shelf so the staff can go out the back and get them.
You're just trying to wind me up. You know how much this bothers me.
I think it winds everybody
because
up.
Because basically this is just a breakdown in the social contract.
Exactly.
And that's part of the problem.
Bremo, society in decline. We'll have this conversation
I'm not
later,
go that far.
right?
Let's be hopeful. Come on,
Stuart Kaiser joins us now, head of US equity trading over at Citi. Stu, we're not going there, don't worry. We're going to talk about stocks. Good morning.
That's quite
to
a
you,
lead-in. Thank you for that. Thank you for that.
Why are you comfortable being long equities right now?
Because we're comfortable with volatility, unlike everybody around the table, I guess. But I think big picture, we still think the macro backdrop is pretty good. If I had to really simplify it down, I think if the labor market and services spending is holding in, then you can be comfortable running long equity risk. Momentum tends to do well into year end. We think that's going to kind of repeat itself this year as well. Rates have kind of, let's just call it, calm down a little bit. We think that'll help a little bit as well. But as you know, our core view this year has been the underlying macro is positive, and you kind of want to be net long equities in that environment, and that remains the case, especially the Dow.
You said, I'm leaving that there. I'm leaving that there. You know that winds me up. TK is just doing this for you. Wants to talk about Dow points. Okay, do you have a Dow forecast?
Of course, yeah, 36,000. I was just looking at it on Tom's screen, actually.
Stop it. You said, if the labour market held in, is it holding in?
I think it is. It's strange that people have tried to talk about the last labor market report like it was super weak. I mean, if you take out the strike, it was 185,000 jobs. The previous, even on a revised basis, was almost 300,000. So, I do think the labor market remains pretty strong, at least strong enough, to keep equities moving higher. Yeah.
If we get Kaiser optimism, do we get a better breadth, or do we get a repeat here of 20 stocks and pick and randomly lead the way?
Into year end, we think it's going to be pretty narrow leadership, and what's worked year to date is going to kind of work for the next couple of months. I think the rotation discussion is much more a 2024 discussion, or a broadening out is much more a 2024 discussion. Scott Kroner, who is our U.S. equity strategist, a key part of his forecast next year is a broadening out in earnings. This year has been very narrow earnings growth. Next year it'll be broader, and we think that helps exactly what you're talking about.
But with disinflation, do you get a weaker top-line revenue off of a weaker nominal GDP?
It's definitely possible, because what surprised the bear case this year was that earnings were nominal. So I think we've been reminded of that. Next year, if you do get a slowing of inflation, it could put some pressure on top line. And the question then will be, how do they manage that from margins perspective? Are they able to maintain margins if revenues are a little lower, given that they've, a lot of the wage growth has been pushed through, and that's pretty sticky.
But at least if Walmart is 2.1 million, round it down to 2 million because it's television. If they got 2 million, I think that means they can fire 100,000, and that's a 5% reduction. I mean, that's the cost visibility that's there for some of the, to do a Disney, if you will.
We're going to be checking that as we get some of the earnings reports, and we are reaching the end of that. I am wondering, though, how any of this features into trading, the day-to-day volatility. Yesterday, Jim Reed of Deutsche Bank said this morning. Markets have been extremely dull over the last 24 hours. Why are they dull? Is it because people just are tired of narrative roulette? Or is it because they're waiting for something in particular to be a trigger to go full bull?
I'm not going to complain about a 24-hour respite, but yesterday was a little quiet. We've had a couple quiet days, and I think it's when the market is waiting for information, and we have a lot of information coming out this week, whether it's Xi, Biden, and San Fran, whether it's inflation today, whether it's retail sales tomorrow, which I think is kind of being under talked about from a catalyst perspective. So if we were quiet yesterday, I think that has a lot to do with it. We've had 2 very painful weeks of a lot of repositioning and rebalancing. So people probably trued themselves up ahead of these events, and now it's kind of sit on their hands until we get the data.
You said that we're underestimating how important retail sales could be. Why do you say that? What is a potential surprise there?
Well, I mean, if you look, last month you had very, very strong positive surprise in retail spending that actually ran counter to our credit card data, ran counter to a lot of the spending data we've seen from other places. We're heading into holiday season. So I actually think, Wednesday is going to be a really interesting test for that narrative. Do we get another strong back-to-back retail sales print, which means people are going to get very bullish about the holiday spend into year end? Or does last month's retail spending look like a bit of a head fake and we kind of start to compress back down to what the credit card data is saying? So I think there's just a lot of potential outcomes from that data.
But then where does that catalyze stocks in a world where people see bad news as good news still because it could mean Fed rate cuts, right? I mean, it's head spinning in terms of what this means for where stocks go. Well,
you're winding me up. You know that I'm a good news is good news person. So look, I think for me personally, if you get another solid retail spending print, I think that's net positive for equities because that'll get people, I think, more excited about the holiday spend going into year end. I think if you get a very weak print, then the market's not going to like that. So I'm still in the good news is good news camp.
You are, aren't you? That separates you from a lot of people who think this is upside down. What's the difference between you and them? Is this just what's worked in 2023?
Well, I lived in New York City in the 1990s, so I'm used to all this stuff.
You've got a different benchmark.
It doesn't freak me out. I like the volatility. Honestly, I think it's just that it can be too complicated, and we've just tried to really simplify it down. And I think if you're long a nominal growth asset, you want nominal growth to remain positive. It's the equivalent if you're driving a car. Do you hope the car will break down so that you can go to the mechanic? No, you want the car to keep driving.
Depends who you are.
Well, it depends who the mechanic is too, right? If it's Putty from Seinfeld, then maybe your answer is a little different.
You're killing me this morning, but you've raised up a really important market question. I really do think you have. When you look at crime in certain cities, you can always sit here and have an extreme benchmark like the 1980s and say it was so much worse then, it's better now. You can do the same thing with equities, always. .com, it's not as bad as then. Is that a decent way of looking at markets, just picking an extreme benchmark just to make yourself feel comfortable about where we are currently?
Well, it's recency bias, right? I mean, you're going to react to what the most recent economic environment or equity environment was. So I think that's one of the big things this year is the most recent comp is 2022, where you had a ton of tail risk from both growth and inflation. You had a huge amount of volatility. So coming into this year when quote-unquote event risk didn't realize itself, it really just made equity markets more investable, I think, and it allowed people to really engage that way. The other thing is yields are very, very high right now, right, from a cash perspective, right? So I think a lot of folks who are not used to that are saying, I can get 5.5% without doing anything. So, that's another aspect to it. But yeah, I think to your point, because 2022 was so uncertain and so volatile and so sort of regime shifting, it's made 23 just, the bar is low, effectively. Yep. And that's probably why we're more optimistic.
Stuart, thank you, sir. It's good to see you. If you're just joining us, welcome to the program. Your S&P 500 is positive by 0.1%. On the S&P, yields are a little bit lower by a couple of basis points, 462. Raises the question, Stu, just how high or low is the bar going into 2024 now? How have we reset things this year?
I think so, just in the sense that a lot of economists have sort of taken out the recessions for 2024, which I think has raised the bar a little bit. Obviously, the price point in S&P, if we enter 2024 on a 45 or 4600 handle, then yeah, I think the bar is going to be higher. So yeah, I think the bar is higher for next year. Luckily, there's still a lot of opportunity. As Tom mentioned, the narrow leadership, I think, is a really interesting dynamic as we get into 2024 because you have a lot of laggards to choose from, and the last 2 years, frankly, January's have been really painful. We've had these very violent kind of rotations in early year. Both
Tech
in
just ripped at the start of this year.
Yeah, and
unexpectedly.
If you go back to 22, you had this huge move into Europe that got derailed by the Ukraine war. So I think early 24 is going to be really interesting. Are people willing to sell the 8 or 10 stocks that have driven the market higher and move into the quote unquote laggards early in the calendar year? So we'll just have to see. It's going to be very fascinating, I think, early next year.
This was good fun. We'll catch up with you hopefully before year end. Stu, it's good to see you. Thank you, buddy. Nadia Lovell of UBS joining us in the next hour. Look out for that. Equities right now just about positive from New York City this morning. Good morning. CPI is just around the corner.
On Wednesday, as you have heard, President Biden and President Xi will meet in the Bay Area for a summit. We anticipate that the leaders will discuss some of the most fundamental elements of the U.S.-PRC bilateral relationship, including the continued importance of strengthening open lines of communication and managing competition responsibly so that it does not veer into conflict. The way we achieve that is through intense diplomacy.
We'll see some of that intense diplomacy later this week. That was White House National Security Advisor Jake Sullivan previewing tomorrow's meeting between President Biden and China's Xi in San Francisco. More on that in just a moment. If you're just joining us, here's the state of play, the scores, if you will, in financial markets. On the S&P, positive by 0.1%. Yields a little bit lower by a single basis point. The 10-year down to about 4 is 62. In the FX market, a euro, positive 0.2%, 107.22 on the euro. Bit of an update on Thanksgiving travel. Don't know if you guys saw this, but the US Thanksgiving travel period is shaping up to be the busiest since 2019. Here are the numbers. 55.4 million Americans expected to travel 50 miles or more from home. This according to the forecast from the American Automobile Association, making it, Bramo, the third highest Thanksgiving travel in records going back to the year 2000. We're getting back to it.
You know, I just think to myself, which is a reason why I don't want to travel this year. But
so many people on the roads.
It's just, yeah, exactly. How much is this because of gas prices? How much of this is just simply people are going back and finally doing the Thanksgiving that maybe they were not doing and going on trips instead for the post-pandemic years? I'm just suggesting, you know, people are going to get back to their routines.
Any signs that we're getting back to normal? TK, they're welcome signs. That's another sign this morning.
I think it's underrated. We're still in pandemic psychology. Granted, there's different flows and glide paths and all that.
But is that becoming an excuse just to exclude family members? That you just say that the other half is scared of...
I would never do that.
That only works. That only works.
I mean, I'm in
Does that work anymore? It doesn't work anymore. That's off the table.
We're not having a large family gathering this year.
We aren't.
We're very concerned. We're very
we've
concerned
got
about
beyond that.
We did that for 2 years.
I'll be cooking in the kitchen, and you know, Mrs. Keene's looking at me. Right? Which restaurant are we going to?
Have you booked this year?
We booked. Yes.
Okay, good.
Yeah, they've extended hours. It's so successful.
Are you going to name said restaurant to get a discount?
We're going to an Alan Ducasse restaurant that I can't say enough about, and they do the usual beautifully, and then they have one or two other things. It's this French word, fixie.
Yeah,
fixie.
Prefix menu.
Yeah, that's it. Thank you, prefix. And, you know, I'll be cooking.
I thought Alain Ducasse was in the Dorchester in London, no?
Yeah, but I'm not going to be at the Dorchester.
Okay.
You know, I'm going to be at his more basic restaurant.
Does it start with a B?
Yeah, it starts with a B.
Okay. End in a T.
You got that right.
Benoit.
That's what we're going to do Thanksgiving. What I'm going to say is this is a sign of the optimism we just heard from Stuart Kaiser. Everybody's cautious, and all the I mean, I'm fascinated to see what holiday spending is like. I have
likewise. For me, Tom, standout this week. It's retail sales and the retailers and what's happening with the consumer in this country going into Q4 and beyond.
We're going to have to see on that. Right now we're going to see, there's so many things to talk to Amory Horton about, seriously, our Bloomberg Washington correspondent, but we've really got to move to tomorrow. Amory, percolating out there is the domestic reality for the President of the United States. The senator from Ohio and others are saying, look, UAW, the Big Brown, UPS, and let's just generalize the AFL-CIO. How is big labor going to be in San Francisco with Biden and Xi?
Well, I think a lot of what drives Biden when he talks about foreign policy is the domestic concerns. So he's going to want to tout the manufacturing legislation that his administration got through, some of that in a bipartisan fashion, at least for the hard infrastructure, but more things like the CHIPS and Science Act, bringing manufacturing back into the United States. If you look at things like electric vehicles, which is the future of the auto industry, China absolutely dominates.
Yeah.
And I think what Biden will try to sell is that not only with the UAW workers were they able to get what they would say much fair wages, but also looking at the future. So, some of these contract negotiations did on the fringes at least, start to look at the future of what the electric battery of a car and that type of manufacturing when it comes to EVs might look like with union workers. And the president himself said he'd like Tesla to unionize next. So I think when the president talks about foreign policy, we're going to try to see him pivot it back to domestic policy, because polls show, again, Americans are not going out on foreign policies when they vote next year. It's on domestic issues. The economy rate's number one. Also, fentanyl will be a huge topic of discussion tomorrow when Biden and Xi meet.
You know, I think of former President Trump in the theater, if you will, of his meetings with the great and worthy of Asia. What's going to be the theater tomorrow that we should anticipate?
I'm not sure President Biden does theater the same way you see from former President Donald Trump. When they met at the G20 in Bali, it was really on the sidelines. They came out, they did a few photos. I think this will be a little bit more of a grand opening, red carpet welcome for Xi Jinping. We saw in terms of what San Francisco was doing over the weekend, the New York Times, when they led this story, talked about it with San Francisco cleaning up. They said San Francisco had the air of, college students cleaning up after a house party before their parents come in. So clearly, everyone is trying to put on a good performance, and it's not just the Biden administration that's meeting with their counterparts, leading up to that Treasury Secretary Janet Yellen and her counterpart, but it's the executives that are joining, as well as some everyday Americans from Iowa that Xi Jinping met 35 years ago. They're being invited to this dinner, these farmers. So this is where you're going to see a little bit more of the theater in terms of this grand welcome for Xi Jinping and the number of meetings he has. But you're not going to see, I think, the way the former president did theater versus this president, which is definitely a little bit more muted in that realm.
Anne-Marie, how much is Xi Jinping's presence muting some of the other discussions being had around the event, given the fact that in some ways President Biden is trying to revive some sort of TPP, some sort of Trans-Pacific Partnership type of agreement that's run into quite a few obstacles?
Well, that has definitely run into quite a few obstacles, especially since we're going into an election year. And this is something that the former President Trump and his populist rhetoric would want to rail against. It's a great question, though, because other discussions that might happen on the sidelines are not going to get the full-on press. Everyone is focused at this APEC summit about the meeting that's taking place adjacent to the APEC summit. And that's Biden and Xi Jinping and his dinner with chief executive officers. But for everyone else that's there on the sidelines, depending how these meetings turn out, that will give them a path forward of how they may deal with relations with Beijing especially when it comes to economically after this meeting between the U.S. and China.
Mate, in all seriousness, what do you make of this cleanup in San Francisco? And is it going to stay that way?
I think you pose a very good question, Jonathan, when you say it shows the ability of elected officials to clean cities up, which I think a lot of Americans are showing in the polls that they're very hungry for. But also, I shrug a little bit because this is nothing new. I actually at one point wanted to write a story about the mini economies that world leaders basically build around them when they travel. I've been in far parts of Russia, and President Putin would show up and they'd re-tarmac every road in these tiny cities. This is what happens when heads of states visit cities. It happens all the time. But I think probably to individuals in San Francisco, they're saying thank you about time. But others are saying, well, why did it take so long? And why did it take the head of China to come to this city for elected officials to actually start caring?
Maybe that means the San Francisco Giants get a new shortstop.
Maybe. Do they need
one? They need one.
Bad year.
Yeah, bad year.
What happened to the Red Sox this year?
We want to forget about the Red Sox this year.
Forget about this season. Look ahead to next season.
Stove league season. Where we talk about.
How's baseball doing? Change the rules. Was getting quicker, right?
The quicker was very successful, but I am shocked at what you've done to me with English Premier League football. I mean, Anne-Marie warned me about this.
You're gravitating towards that on the weekend.
No, I just think the slow motion and the endless commercials is just too much. I love English Premier League. They throw the sponsor up there.
Just start the
it's
game.
There while you're there, and they just play. Anne-Marie agrees with me.
AMH agrees. She's gone. She agrees so much she's left.
I'm shocked.
AMH, thank you. Down in Washington, D.C. Coming up shortly, Woody Caesar, a credit site on this credit market. Right now on this equity market, equity's just about unchanged on the S&P 500. We are 1 hour and about 4 minutes away from US CPI data. That's your main event. It's coming up a little bit later. From New York, this is Bloomberg. Equities on the S&P 500 just about positive. Your main event in about 60 minutes. We'll get to the inflation outlook in just a moment. Here's the backdrop for equities this morning. In the stock market, we're positive by 0.06%. On the Nasdaq, up by 0.2%. Just a touch softer, negative on the Russell. The small caps lower this morning by 0.1%. If you turn to the bond market, let's sit on treasuries for a moment. 2-year, 10-year, 30-year. 2-year yields just about unchanged, north of 5% still on a 2-year going into inflation. If you think about where we were the morning of the last inflation print, I was looking at the numbers for you just yesterday afternoon. The 2-year opened that day at about 5%. It's where we are. The 10-year opened that day at about 4.55, back down to about 4.62. So basically, yields have had quite a ride, quite a journey in the last month or so, but yields are almost back to where they were the morning of the last inflation print, almost across the board here. Beyond bonds, into foreign exchange, we look like this on the euro. The euro at the moment looking at a third day of strength against the dollar, 107.23. That currency pair positive by 0.2%. Lots of data this week, also lots of earnings as well. I just want to sit on Home Depot just for a moment. Came out with numbers a little bit earlier, still looking for a revenue decline, just narrowed the range for that revenue decline, Lisa, a little bit earlier this morning. But the line that jumped out for you is the line that jumped out for me. The pressure in big ticket discretionary categories. Are we going to see more of that through the week?
Is this just a housing-related specific issue, or is it broader? And I think that's really we're going to parse through with the retail sales figures that we get tomorrow. And then with Walmart earnings on Thursday, what we're seeing is a stock that's been beaten up this year on high mortgage rates and the fact that people are investing less in their homes after gangbusters years in 20 and 2021. How much, though, does this really cross over with this big-ticket discretionary spending to the other sectors?
And to the question for Stuart Kaiser in the last hour, the basic idea to me is what happens at the top line. This is a company that's, done some solid upper single digit work over 20 years. And all of a sudden now it's lower single digit if they're lucky. That's the key thing to me today. And you frame out, how do you fix that? And as Mr. Kaiser mentioned from Citigroup, there's one easy way to fix it. You cut costs. Maybe Disney's out front on this with the ardent costs we're seeing in streaming.
Well, they're under huge pressure, the cut costs over
that's
Disney.
a structural issue. I get
Without
it.
a doubt.
Home Depot's worried about, John, I take
1/4
real issue. The 1/4-inch, 3/8-inch ratchet socket set from Milwaukee. Is that a discretionary item? That is not a discretionary item.
It sounds discretionary. What is that?
$268. And it comes in a fancy thing there,
And that's a staple for you.
Yeah, you
course.
can put together grandchildren's kitchens with that.
I've got no idea where this is going.
Stuff.
This will generate some intrigue. The story that's just crossed from Axios this morning.
Huge deal.
I'll share the lead paragraph with you. JPMorgan Chase CEO, according to a top banking source speaking to Axios, Jamie Dimon has been talking privately with GOP presidential candidate Nikki Haley about the global economy and believes she has the potential to bring the country together. According to this reporting, according to this source speaking to Axios, Dimon admires Haley's grasp of the economy and her recognition of the role that business and government can play in driving growth by working together. I don't know this morning, and I'd love your view on this, Lisa, whether that generates more intrigue about Nikki Haley or Jamie Dimon this morning. Where do you sit on this one?
At this point, everyone's been speculating about Jamie Dimon as U.S. Treasury Secretary or some other position. Pick your post in any kind of cabinet. There is a question about what his involvement is, but he crystallizes this idea of support from the establishment for Nikki Haley. She just has to get through the primaries, and then a lot of people think that she has an easy win versus President Biden. But that's a big if, because everyone's talking about Trump as the front runner.
Well, if you get support from the establishment, does that get you support from the electorate, particularly the base, in a primary? become the Republican candidate.
Or is it actually the other way around, right? Does this actually harm her chances with the primary debate? Look, this is sort of this ambiguous moment in politics where the primaries skew very much to the polls rather than to the center, but the entire electorate is skewing more to the center, which raises questions about the primary system, et cetera.
Well, what's interesting about this, Secretary Diamond's out front on this. I mean, I'm looking at his annual report, 64 pages, whatever it was. Potential trouble brewing from unprecedented fiscal spending, quantitative tightening, and geopolitical tensions. Secretary Diamond's out front with his brief as he considers potential office.
When I ask where the intrigue would be after a story like that, your intrigue is more with Jamie Dimon and JPMorgan.
No, I think we have a national candidate gaining momentum, and in a former president who is decidedly incumbent. But I do think a lot of people have talked about a Secretary Diamond. Okay. Full disclosure, take it over to the passive world. They've also talked about Secretary Lawrence Fink. I think these are in the zeitgeist of global Wall Street.
I imagine Mr. Diamond meets with a lot of people. And we'll probably see a lot of stories
That's
like
probably
that
what you'll hear from Joe today out of JPMorgan when you guys have lunch.
Sure. I'm not sure that lunch is happening. Under surveillance this morning, just 1 hour away from US inflation data. Let's get through some stories for you. The report expected to show slower progress towards the Fed's 2% inflation target, likely keeping the central bank biased towards more tightening. Bloomberg Economics predicting consumer prices, excluding food and energy, rising 0.3% for a second straight month in October. Your next story, the House of Representatives set to vote today on Speaker Mike Johnson's new short-term plan for funding the US government. Johnson's plan facing opposition from at least 8 hardline House Republicans who want immediate spending cuts or changes to immigration law. His proposal would need a 2/3 majority in order to pass, opening the door for a possible bipartisan solution, Elisa, ahead of Friday's deadline.
Which is exactly what got Kevin McCarthy canned.
I was going to say that was verbatim where we were X number of weeks ago, wasn't it?
Which raises this question, how is this time different? Can we see Michael Johnson retain his position and clout even if he moves ahead with some sort of bipartisan plan?
This one's going to linger all week, isn't it?
Yep.
Okay, so let's go to the next story. President Biden set to meet with China's Xi Jinping in San Francisco tomorrow. The two leaders expected to announce an agreement that would see Beijing crack down on the manufacturing and export of fentanyl. Under the deal, which is still being finalized, China would go after chemical companies to stem the flow of both fentanyl and the source material used to make the synthetic opioid, which has been fueling, Tom, a years-long public health crisis here in this country.
Our romance of China and Shanghai and heroin, or maybe out of Southeast Asia, is poppies and people carting them out. This is baloney. There are 3 methods: Janssen method, Siegfried method, and Gupta method. Is something as inorganic as phenethyl bromide. Don't ask me. I did poorly in chemistry in school, but this is deadly, deadly serious, limiting inorganic chemicals which come out of China and make up this killer 50 times more powerful
and
than
go
heroin.
through Mexico, Tom,
Yeah,
across the border.
via
So
Mexico
this is becoming a
cartels.
huge political issue in this country.
These are not
DK,
TV shows.
going
This is
into
the
next year.
real deal of inorganic chemistry killing people.
It's a big issue, Tom, particularly for 2024.
Yeah, absolutely. We're going to continue on here. We're really focused here, 50 minutes away from this really important CPI report. Joining us now, Winnie Caesar, Global Head of Yield at Credit Suisse. Winnie, wonderful to have you here. I got 8 ways to go this morning. Let's go to the inflation report. How does your world react to inflation? What do you expect at 8:30?
So we do expect that the inflation report could come in a little bit hot, just given some of the moving pieces at the line item level. Now, we're not particularly worried that there's going to be a massive gap higher in yields, especially in the long end of the curve. We saw the 10-year hit 5% and has come down pretty nicely since then. But we do expect yields to be relatively stable. And for corporate credit, we think that the outlook looks pretty good, with U.S. investment grade still yielding north of 6%, high yield at 9%, with double Bs in that 7 to 7.5% area. That's really attractive, even if core inflation is trending at kind of 4% year on year, as we do expect disinflation to continue throughout the next 6 to 12 months.
It is attractive if you're an investor. It is really unattractive if you're an issuer that's gotten used to paying rates of below 3% for so many years. There was this report out from CalcBench that Bloomberg got a hold of that showed that non-financial companies in the S&P have more than $100 billion of debt coming due next year with coupons below 3%. Refinancing at current rates would add another $3.1 billion in collective interest expense, additional to what they're currently paying. How much does this alter the fundamental profile of some of these companies?
So I think you have to be very careful in discussing which universe is going to be most impacted by these higher borrowing costs. For the investment grade world, where you have much larger term structures of debt with much more kind of segmented maturities, with some in the near term, some in the immediate, some much further out, and also very robust cash balances, which is actually allowing a lot of corporates to kind of operate like banks and generate positive net interest margins. That is not, to us, a particularly threatening issue. For the high yield universe, and especially the leveraged loan universe, you have very large percentages of capital structures maturing in the next, call it 2 to 3 years. For the loan-only capital structures, there is a number of companies where 100% of their outstanding debt are actually going to come due in the near term. And so they're going to have to refinance entire capital structures at materially higher rates. And that's where we're most concerned. But for a lot of the corporate credit market, the maturities at higher financing costs are not going to be quite as detrimental to fundamentals.
Within investment grade, what you just said there, that some of these companies are operating like banks, that their cash piles are earning that 5% interest and can offset any additional increase in borrowing costs. How much are they building those cash cushions with the expectation that that kind of basic interest revenue will continue?
So the real build in cash was during the pandemic, when we saw borrowing costs at, rock bottom lows, and also earnings were good. There was solid profitability across a wide range of companies. Now, since then, cash balances have come down, but they're still very elevated relative to pre-pandemic levels. In aggregate, I realize that it's not all evenly distributed across the market, but in aggregate, cash balances are still quite elevated. And we are seeing that management teams are still very focused on cash management, balance sheet management, ensuring that their capital structures are appropriate for whatever this next move is, be it a continuation of higher borrowing costs or a deceleration in economic growth and earnings.
It's a big challenge for next year, whether we get that deceleration. Winnie, thank you. Winnie Caesar there of Credit Suisse. We've been waiting. Subtle signs of it. We've been talking about those subtle signs, Bramo, all morning. Claims starting to inflect just a little bit higher. Delinquency starting to climb. Is that slowdown, Lisa, just around the corner? And
this is sort of what people are banking on, which is maybe underpinning the conviction in bonds that we're hearing out of that Bank of America fund manager survey. We'll see. I mean, honestly, that's why retail sales, to echo what we just heard from Stuart Kaiser, is so important on tomorrow and then on Thursday with Walmart.
If you're UBS and you've got Abramowicz essentially saying that Fed funds is going back to a one handle, must believe that this Treasury market is a screaming buy. Right now, if you believe we're going back to 1% on Fed funds.
Ian Lingen at BMO Capital Markets is there. John, we're up 3% on the 4-week moving average of claims. Just teensweets, and it's just underway. But there it is. But Bawaja has decades of experience.
Tons.
This isn't some young Turk out there trying to make a name for himself. This is an acclaimed guy who stops audiences in Southeast Asia, among others, for UBS.
If you're just joining us, we'll continue this conversation. Equities at the moment just about positive by 0.03%. Yields are a little bit lower by a basis point, 462. Comes down to one question, TK. Do you think the world has changed? Is this truly a different regime post-pandemic? Abramowicz over UBS is essentially saying he doesn't think this time is different. This is not new. We're going back to the old world.
And John Williams,
come back down to one.
In one of the 45 speeches he's made in the last 32 days, John Williams talks about this. We're going back to the regime he envisioned before. And so I think the arch debate is, Do we still go, OMG, bad news is whatever Lisa talks about? Or do we go back to what we knew years ago?
All right.
Do we go back to 2018?
Okay, hold on a second.
Okay.
All right, well, then I'm going to challenge you on something that you just said.
Okay.
You said he's not a young Turk. He's someone who's been on Wall Street. What's wrong with young Turks? I mean, honestly, people coming in and seeing the new technology and understanding what the change might actually be.
What Marco do today? Marco reaffirmed.
Hey, don't involve me. Carry on. I'm loving this.
Oh, are you actually? No, but seriously, I mean, at a certain point, we are seeing some fundamental sea changes in, the structure of how we do business when it comes to tech, when it comes to how that may revolutionize things. How much does that change some of the baselines?
Are we going to go back to the gross cancel the break? Are we going to go back to? Are we going to go back to the gross macroeconomics we knew before, or is there a new regime out there? I would suggest with technology, we need to be sober about saying it's going to be 2019 again.
This was great.
This is great.
So I enjoyed that. I'm so excited for the next commercial break.
I can't believe what our therapist
cannot wait.
Lisa, we're not doing this again.
For what's about to come.
Last month, you had very, very strong positive surprise in retail spending that actually ran counter to our credit card data, ran counter to a lot of the spending data we've seen from other places. We're heading into holiday season. So I actually think, Wednesday is going to be a really interesting test for that narrative. Do we get another strong back-to-back retail sales print, which means people are going to get very bullish about the holiday spend at year end? Or does last month's retail spending look like a bit of a head fake and we kind of start to compress back down to what the credit card data is saying?
Stuart Kaiser of Citi was just absolutely fantastic a little bit earlier this morning, just looking ahead to some of the retail sales data we get tomorrow morning. And I'm with Stu. This week for the retailers, for the consumer, huge week. We'll get CPI in about 45 minutes time, then on to tomorrow morning with retail sales just around the corner. Equity futures look like this. Here are the scores. We're totally unchanged on the S&P 500 and going absolutely nowhere for a second session potentially. We'll see if that changes. The fate of this session seems to be in the hands of the data point we get a little bit later this morning. Yields coming in a couple of basis points on a 10-year 462.21. Just a sneak peek of foreign exchange for you. 3 days of euro strength against the dollar, 107.25. We're positive there by 0.25%. I mentioned this week is a big week for retailers. We had Home Depot out with earnings a little bit earlier this morning, narrowing its guidance for full year profit and revenue. The CEO weighing in on earnings saying this: similar to the second quarter, we saw continued customer engagement with smaller projects. And Tom, this is the key line for Lisa. She mentioned it as soon as the numbers dropped. Experiencing pressure in certain big ticket discretionary categories. That's a big focus for us this morning.
Yeah, that's part of this. There's a story here of a company that's up 20% per year since time began, and you wonder again how they adapt out of this to the domestic. I just had with Lisa, it's really a question of how do we move on beyond the pandemic, and it comes down to how America adapts to this and what they do at Lowe's, Target, in Home Depot. I think it's a massive mystery.
They had a massive merchandise problem, Tom. They couldn't get enough, then they had too much.
Yeah, exactly. These
Still
are
working
pandemic
through some
changes.
of these issues, yeah.
And they're working through it. And, I'm going to see it. I mean, Lisa, you're looking at one of those refrigerators. You see this refrigerator she's looking at?
Double doors?
Yeah. Like, she hit the kids with one of the doors and
that would be great.
Maimed them.
Yeah, I am buying a refrigerator. I'm trying to move against the trend.
What's the door like? Because mine has glass in it, and you can see into the refrigerator. So it's very well organized, as you might expect.
Of
Everything's
exactly.
nicely lined up.
And if anyone moves it,
everything's got a place.
Yeah, and if anything changes, then
I'll
we have
notice
problems.
and it'll get pushed back. Not problems. I'm not going to go mental. I'm not mental. I'm not.
I'm not mental.
Everything's just very well organised.
Yeah.
I can't imagine.
I don't think mine's going to be.
Can you imagine his refrigerator?
Mine's going to be absolutely opaque doors that nobody can see inside.
It's like my Christmas tree.
I know.
Just,
perfectly orchestrated.
Just right.
Tom.
We don't talk about my refrigerator. Here's what we know. In Western Massachusetts, there is all sorts of academics, and the acclaim of one Smith College in their applied mathematics program is legendary. It's equivalent to the Williams College PPE wonderment a little bit further out to the far west. Joining us on applied mathematics of big box retail, Elizabeth Suzuki joins us at Bank of America Securities. When you were going through polynomials and doing Ferris proof and all that in applied math, you think you'd be in aisle 4 at Home Depot?
I did not. I never thought that my work was going to include channel checks at stores that I just go to anyway. In fact, now, as a homeowner for the last, 6 years, I'm in Home Depot pretty much every weekend, maybe every other weekend. But I mean, it just never stops.
Wonderful. I've never been to the one downstairs. Ferro's down there once a week picking up something. Let me cut to the chase, which is the new post-pandemic Home Depot world, and for other big box as well. Can they fix the problem on the income statement? Mm-hmm. Can they take out expenses like Disney or you name the bank?
Sure. I wouldn't really categorize it as a problem on the income statement. When we think about what Home Depot is going to do this year in terms of sales, they're probably going to end up about 50% higher than they were in 2019. And just putting that in context of the broader industry, which is tracking up about like 20% versus 2019 levels, that's an amazing amount of market share that Home Depot's been able to take. I mean, we're coming down off of these very, very high levels of spend during the pandemic. Homeowners had, easy rates to be able to borrow against. They also had, stimulus money to spend. They were moving at much higher frequency. A lot of people moved out to the suburbs during the pandemic. I mean, we've seen a slowdown in that. And, I think what's been surprising this year to the downside and just where we've seen that pressure on the top line is really mostly from housing turnover basically coming to a standstill. So as we expect,
really?
So I think, as rates start to moderate or potentially even come down, maybe towards the second half of next year, I think that's going to help spur that housing turnover again. And we're going to see more of a return to normalization in terms of that top line sales growth.
Given where mortgage rates are, do you really think we can normalise the fact that there are some people just locked in their homes with a 2-3% mortgage who just aren't moving anytime soon?
Yeah, I think it's like once rates really stabilize, maybe come down a tick, a couple of rate cuts potentially in the second half of next year, then, the homeowner is saying, okay, like rates are probably not continuing to go up. I can potentially refinance if I were to, move today. I'm locking in a rate that's higher than what I wanted, but I feel like there's some potential for that to come down over time. And maybe it means that people buy a house that's a little bit smaller than what they wanted, or it means that, some people who are moving and, are going to have to absorb a higher rate. But because households have such high levels of savings, they actually can absorb that. It's just, it is uncomfortable, right? So right now we're feeling that discomfort in terms of existing home sales, which are the lowest they've been in 13 years.
How much does Home Depot rely on the housing market versus the fact that if people aren't moving, they are buying new refrigerators, I'm just saying, or they're buying new stoves or new microwaves or other items in the house that might break? I mean, at a certain point, does that actually help these companies?
Yeah, I mean, the sector is not as sensitive to housing turnover as one might think. I mean, when you're seeing these, negative data points on housing every day, and if you already have sort of a negative bias, each one of those data points just kind of confirms your bias, and you're going to say, of course, things are terrible right now. So what we've done is we've tried to look at basically every macro factor you possibly could, and this is really where, that applied mathematics comes into play, is we built a proprietary indicator of home improvement demand. And we narrowed it down to 14 different factors that are reported monthly that we can correlate to Home Depot and Lowe's same-store sales growth. Because at the end of the day, that's pretty much what drives these stocks, is same-store sales growth. So we narrowed it down to these 14 factors. We built an indicator off of it, and then that indicator helps inform our views where we don't have to be dependent on the company's guidance. We don't have to be dependent on third-party forecasts. Like we're able to actually look at the factors that matter, and then month to month, we can track each of those factors and not get distracted by the noise that we hear in a lot of these other data points.
How correlated is Home Depot to some of the other retailers that are not related to the housing or home improvement sector?
Yeah, I mean, that's a really interesting question. And I think, when we boil it down and look at the broader sector and look at Bank of America's credit card data for the home improvement retailers, which is, just very broad category, Home Depot has outperformed that group pretty consistently, like actually very consistently over time. And Lowe's has as well by at least 200 basis points. So, the market share gains here are pretty material. And that's something that I want to just continue to kind of hone in on in this result, is even though their sales are down 3%, we've seen the category down, mid to high single digits year over year for most of this year. But in terms of correlation to, to other retailers, it's pretty independent. I mean, it's some factor of the broader consumer and the health there. And so obviously there's correlation to like a Walmart and a Target. market. But because it is related to housing, and really home prices are one of the most important factors driving home improvement demand, that's really where it kind of differentiates.
We've all been surprised by the strength of this economy this year. There's a bunch of companies that fall under your coverage. We're trying to work out whether we are at the precipice just around the corner from a severe weakening of the economy. Do you see any of that emerging whatsoever going into year end?
Yeah, I mean, I think that there are categories that we follow that are struggling more than others. Appliances, we talked about refrigerators. I mean, appliance sales are down. The volumes have been under pressure. Margins are coming under pressure as well. We saw promotions that started in October for appliances. So you should get on it if you're in the market for a fridge, because I think those promotions are going to be, pretty attractive this year.
You need the camera on Grandma. She looks so happy. You're so impressed with yourself. What kind of discount did you get?
No, I just want to hear what you have to say. Carry on.
But consumer electronics is another one, right? I mean, as Home Depot said in their press release, they're seeing pressure on big ticket consumer discretionary products. So consumer electronics, definitely one of those. Appliances kind of fit in that bucket as well.
Ken from New York University just emailed in. So you're sitting here with Ken Langone. He's going to go, this is all a lot of great chat, but the bottom line after 3 years pandemic malaise, let's call it, is can they get back on track to the total return that we were weaned on? Can they get back to 16, 18, 20% per year share return?
Yes, I think, in this current macro environment, that's tough, because the consumer is pulling back on spending, and we are coming off of this, sugar high from the last couple of years. But, as we look to 2024 and 2025, we see no reason why there shouldn't still be growth in the home improvement sector beyond the broader economy.
Liz, this was great. Thank you. It's good to see you in person as well.
Yeah.
Getting back to normal. Just want to see more of this.
You just see her down at Home Depot underneath us.
I know. I'm going to make a shopping trip on my way out.
At least I've been to the Home Depot beneath us.
I just am channeling Will Ferrell.
TK's never been. Never been
old school
to a Home Depot.
I know. It's good Saturday activity.
Right now, you're seeing really different signals in different parts of the market.
What's going to matter? The slowdown? How big of a slowdown is it? And importantly, what will the Fed's reaction function be?
As inflation declines, real rates will rise, and this means the Fed has scope to cut rates.
What's not changed is sort of cautious near-term outlooks.
If we lose the labor market, we lose consumers. If we lose consumers, we're done.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene's CPI Tuesday. It is on radio, on television. In the next 30 minutes, your world's going to change with the direction of disinflation, the character of disinflation in America. I'm sorry, John, 8:31 a.m. is an unknown.
I think it's a three-part act, Tom. It's just one part of the broader story. Get inflation data later, retail sales tomorrow, and we'll hear from the retailers as well. What is the state of the U.S. consumer at the moment?
Yes.
Keep going back to this line from Deutsche Bank. The latest data remains broadly consistent with end-of-cycle dynamics. Is it? Starting to see claims start to pick up, inflect just marginally. Is that slowdown really just around the corner? Because we've been talking about that now for 12 months.
We're going to dovetail this with the outlooks. We're just starting to get out the outlooks as well. What a great job by our team. Greg Bowdle, the Bear, on earlier. Stuart Kaiser, optimistic as well. We're going to talk to Nadia Lovell in a moment. And the CPI report, John, folds right into where will the stock market go.
I'll get the outlook from JPMorgan, Marko Kolanovic, with this to say this morning. We believe stocks and the risk reward for them remains unattractive. Goes on to say restrictive monetary policy is likely to remain in place for some time. Equity valuations are rich, and consumers are likely to begin to retrench. I go back again, Tom, to that last line. Are consumers likely to begin to retrench in the Q4?
And the news we'll see in 28 minutes here as well. And, of course, part of this is the debate, the wide dispersion that we're seeing. And, Lisa, it's from Greg Bowdle, 4150, out to Ed Yardeni with that bombshell, I believe, yesterday, at 5400 on SPX. We provide a service here with a calculator on the Bloomberg Professional Service. That divide in SPX is almost 10,000 Dow points. That's the separation.
Wow, I'm going to have to translate that somehow into the S&P points
John
that I'm
will do
looking
that for
for.
us.
Yes, I'm sure he would be happy to. Honestly, I think that one of the biggest question marks is this time different? And everyone hates those words, right? But essentially, if you don't believe this time is different, there needs to be a slowdown. There needs to be some sort of increase in unemployment rates that is commensurate with something, if it isn't a recession, a serious slowdown. If this time is different, then we don't know what the new normal is that we're going to, which really explains that range of 10,000 Dow points that you calculated somehow.
And to the China visit tomorrow with the president, I mean, the basic idea here is there goods deflation, goods disinflation, or that subset I don't understand that Mike McKee will tell us about of some form of core service sector. Will that be the dynamic at 8:30?
I think it's going to be just as simple as if core inflation accelerates more than expected, that's going to throw a lot of cold water on the thesis that a lot of people are coalescing around, that disinflation has taken hold. We've seen the peak in bond yields, and inflation is going a lot lower.
I look, John, at this, and to put in equities, bonds, currencies, commodities. There's a global piece. George Saravelis with that shocking piece from Deutsche Bank linking the inflation trauma of Japan right over to something like the inflation report here in 27
Well,
minutes.
let's work through it, Tom. What are we converging towards? 2% or 3%?
That's the arch debate.
And
yes.
what's the difference for the
Yes.
Federal Reserve? And let's go a step further. We've had, 18 months, close to 2 years of inflation picking up here. Is that starting to become embedded in inflation expectations? Andrew Honhorst of Citi reflecting on this. I think it's important just to reflect on some of the data we've had. I know I joke a lot about you, Mitch, consumer sentiment, because of how many people they call to get that reading, but let's just go with that data for now. In that data, the surprising point of that going into the weekend is that gasoline prices have pulled back, yet inflation expectations were higher and
3.2%.
consumer sentiment was lower. I think it's worth asking the question, has higher inflation started to become embedded into consumer expectations? And what does that change about what we could converge towards? 2 or 3? And what does it mean for Fed policy next year? When you've got some banks on the street making a call for 2024 of a return to the old story, back to the ones on Fed funds.
Before the data check, though, what's important here is in 26 minutes, Lisa, we're not going to get a cumulative inflation study back to 2019, and yet 110% of our audience, that's how they're thinking. That's how I'm thinking right now.
I was reading, actually, a report on the psychology of inflation last night, because that's what I do with my time other than buy refrigerators. And there's this real idea. People focus more on how much prices have increased. Even if their salaries increase commensurately, they don't count that in their calculation of inflation. They feel worse from the bigger prices that they pay, even if they're receiving bigger paychecks on the other side. That is the reality underpinning this inflation pressure.
Without a doubt, and that's why people don't feel good, Tom, about this economy in a lot of places.
Inflation, where do you begin? I'm going to go to the real yield, 2.30%, John. As we look at the data, it's going to change here in 25 minutes.
It's quiet. I keep saying this. It's been a quiet start to the week, but it's about to get busier in about 25 minutes' time when US CPI drops. Equities at the moment positive by 0.1% on the S&P, just about. Yields coming in a couple of basis points, 461.81. Crude settling down. This is not the picture in the commodity market we expected maybe a month ago. Looking at 1 month, we're back in the 70s on WTI, in the low 80s over the last week, Tom, on Brent crude.
Team Bloomberg Surveillance has just outdone themselves in the last 24 hours on the stock market, on where equities are moving. Greg Bottle joining us, Stuart Kaiser joining us, and now we do a hat trick of quality with Nadia Lovell, Senior U.S. Equity Strategist, UBS Global Wealth Management. Nadia, you're sort of in between here. I'm not going to call it consensus because at 4,700 SPX, you got a lift to the market. How do you respond to the set of things we need to shock and get a much better number, as Ed Yardeni suggests?
I think you need to see a healthy reacceleration in earnings growth. We are looking for that next year. We're looking for high single-digit earnings growth. But if you can get double-digit earnings growth, at the same time, you'll have bond yields coming down because inflation has come down, not because of a slowdown in growth. And you could see further upside to the market well above that 5,000 range.
Can we pick a sector, Nadia? You still like energy. You still think crude's going to be in the mid-90s maybe next year. Nadia, walk us through that. What brings about that story for you?
Yeah, Yeah, it continues to be on the supply side. I mean, reality is this pullback that we've seen in oil prices is not reflecting the solid fundamentals and the tightness in the oil market. The supply picture continues to be constrained due to the OPEC cut, and also the demand picture remains pretty solid. It is a bit uneven. You are seeing strength in areas like China and India and some disappointment within Europe. But we think ultimately that the oil market will remain supplied. OPEC and Saudi Arabia will maintain those cuts into early next year, and that will help to support oil prices. And so we think that this pullback and lighter position does provide an attractive entry point into energy and oil to sort of capture that upside.
Based on that rationale, Nadia, can you be bullish on oil and not bullish on consumer discretionary, which also would benefit from some of those trends?
Now, remember, consumer discretionary as a sector is very concentrated. The top two companies account for much of that sector. So our view on consumer discretionary and neutral is more reflective of our view on those top two companies. Also, reality is the recovery in the consumer is somewhat uneven. It's continued to be the higher-end consumer that remains solid, but the lower-end consumer is struggling. And remember, also, within consumer discretionary, that sector is more driven by the goods area of the economy and less so by the services sector, where we're seeing a bit of a pickup in spending around that.
We've been talking about the different events that are going to be happening this week that could potentially be market moving, including what we're going to get in about 21 minutes' time. Which event or which data point do you think is going to be most important for you as you craft the nuances around your message heading into 2024?
I think in terms of, of course, everybody's watching the inflation numbers coming in shortly, but we are more focused, honestly, tomorrow on the retail sales numbers. We know retail sales have been pretty strong the last couple of months, and this retail sales will give some clues on the impact of resumption of student debt repayment, and is the consumer remaining resilient? And so that's why we're closely watching that. We do know that the Americans and consumer does have the propensity to spend in the fourth quarter and into the holiday season. So we'll be listening very closely to retail earnings and commentaries from those companies this week to see how the holiday season is going. We did hear last quarter, as you remember, from some of the retailers, a pickup into delinquency on some of the stores' credit cards. So we want to see what is the overall health of the consumer and is that continuing into the fourth quarter. So we think that that's more important. The inflation data, I think there's a bit of an expectation already that it could come in hot. And so if it doesn't come in hot, that could be a positive for markets as well.
Nadia, we've been joking about the economist who cried recession all year. There's always been a long list as to why the consumer is about to weaken, why we're about to enter recession. Student loan repayments in Q4, part of a long list. Can you think of some tailwinds to growth in 2024 that you think might persist beyond some of the warnings we've had? Goldman Sachs are on board. Jan Hatzius, I'm sure you saw the outlook from them recently, talking about tailwinds to growth in 2024, the disinflation can continue and ultimately the labour market can remain strong. Where are you on those points, Nadia?
Yes, we're not calling for a recession next year. We think that we will get a period of slower growth, but that's not surprising. We've had 4.9 GDP in the third quarter, so it's not a surprise that we should see a slowdown. So we're looking for more something in the 1 to 1.5% range. And reality is, as we know, the consumers still have a lot of excess saving, particularly the middle and higher end consumer. The job market does remain strong. And reality is cash is or have a yield now, and consumer wealth has been pretty strong this year, and we think that continues into 2024, and so that could help support economic growth in 24, despite some of the headwinds that we're watching into as you've listed, student loan repayment and sort of a normalization in delinquency and credit quality.
Nadia, thank you. Nadia Lovell there of UBS Global Wealth Management. The outlook for 2024, the price target remains 4,700 on the S&P 500. If you are just joining us, anticipating US CPI, it's about 18 minutes away. The scores look like this going into the data point. In the equity market right now, we're positive by 0.1%. Yields are lower by a couple of basis points. 462.21 in the FX market, a euro 107.22. The state of play looks like this. The number drops at 8:30 Eastern. We'll hear from Jay Bryson of Wells Fargo. Reaction from him. Mike McKee's going to, of course, break down the number for you. Ira Jersey of Bloomberg Intelligence, and David Kelly of JPMorgan Asset Management. We're pretty stacked if you are just joining us. Your equity market positive by 0.1%. TK, pretty stacked going into the data point in just a moment.
David Kelly's a key interview here, conversation here to see how he's adapted. David Kelly was way out front, suggesting finally we'll see non-farm payrolls break to a lower positive statistic. Dare I say, he said, a negative statistic. We've yet to see that. We need an update.
What I think is fascinating is just the lack of certainty around anything, and the fact that a lot of people are looking past CPI, that once was the most important read of all of the different metrics, and going to the retailers. The biggest mystery of how much people are willing to keep spending and accepting higher prices, which really feeds into the CPI reprint that we get in about, I guess, 17 minutes now.
It's going to sound philosophical, but ultimately, is a soft landing a moment in time and not the ultimate destination? It feels like one right now, but what are we going to end up in? And some people believe that the price you've got to pay to get inflation lower is ultimately softer growth. You can do a lot on the supply side of things, and maybe we have done already. But if you do believe in these long and variable lags, then growth is about to get hit, isn't it? Based on this massive tightening cycle we've seen from this Federal Reserve.
The only way that you can truly get inflation to come in is if people protest against prices going up too much. And what we saw from McDonald's and what we saw from Starbucks is they're not really protesting that much with burgers and with lattes.
I looked at McDonald's on Uber Eats over the weekend.
It's high.
You see how expensive it is? I didn't buy. You see how expensive it is?
You're just doing
to go to McDonald's. I was doing research ahead of CPI. Do you see how expensive it is?
Yeah.
It was like $15 for a meal in New York City.
It's a new price point that's being paid, and that's the key.
Insane, TK.
They're testing the consumer, and so far the consumer said, fine. We'll see how that pricing power goes.
I didn't say fine. I walked away.
You wouldn't have ordered from McDonald's anyway, would you?
I was watching The Golden Bachelor. I wanted a milkshake and a burger, and I didn't get it.
The Golden Bachelor.
The Golden Bachelor. It's very busy.
I'm afraid to ask.
Let me start with the Moody's decision. They maintained the U.S. AAA rating, but indicated that there's a negative outlook. This is a decision that I disagree with. The American economy is fundamentally strong, and Treasury securities remain the world's preeminent safe and liquid asset.
That was Janet Yellen, Treasury Secretary, speaking at the APEC Summit in San Francisco. Let's dissect some of that. Lisa, hard to argue against the last line, that Treasury securities remain the world's preeminent safe and liquid asset. Hard to argue against the American economy being strong because ultimately we just delivered close to 5% GDP growth in the third quarter. But that wasn't what this downgrade was about. This downgrade was about governance issues, which are clear and evident in DC and have been for a long, long time. And it was about the debt trajectory of the US, which is clearly on the wrong trajectory. And it doesn't matter who you speak to. Pick anyone. Former New York Fed President Bill Dudley, unsustainable fiscal path. Hard to disagree with what Moody's said coming into the weekend based on all of that.
In some ways, Moody's is making a rate call, which is something that you pointed out earlier in the week. And at some point, Janet Yellen's also making a rate call that rates are going to go back down to what they used to be, which changes the debt trajectory and the interest payment trajectory. And this ultimately is underpinning a lot of the uncertainty in markets and, frankly, the credit profile of the United States.
Based on what I hear from some commentators, it's almost as if you shouldn't get a credit rating for America. They should be permanently AAA. They should be the sun in the middle of our universe, and everything else is just planets going around it.
How do you really feel?
Seriously, that's basically how the commentary goes. They should be AAA, firmly AAA, etc., etc. If you don't believe that, and if you think they should be based on what dynamics look like relative to other countries, relative to other AAA-rated countries, sovereigns, America is so much worse than those other sovereigns. This comes back to that same issue. Do you believe America has a unique privilege to act recklessly? They have done for a long, long time. Do you think it is losing that privilege, Tom? Arguably, based on the last decade or so, it's losing that privilege. And ultimately, you have to pay a higher price now to get that deficit away than you did before.
Full disclosure, I grew up in a house that worried about this 24/7. My mother was the ultimate debt worrier. John, the real question here is the rate of change of recklessness. And right now, and there's been some great charts just on Twitter in the last 24 hours, the rate of change of interest expense, of entitlement expense, is moving in directions that are distressing.
But it's not just governance issues, Tom. It's not just about our inability to talk to each other down in Washington, which is clearly a problem. It's about successive governments blowing out the budget deficit. To have a deficit of 6% of GDP with GDP close to 5% and unemployment until recently in the mid-3s. Tom, make sense of that for me.
The unemployment is the productivity and might of our economic growth. And what's bailed us out is quality economic growth versus the rate structure of all that fiscal policy. And many are saying that's changing, to your concern, where you're going to have an R, in the formula, R is going to be more than G, and that's not good.
And I'm not sitting here saying we're going bankrupt tomorrow. That's not what we're talking about here. This is about what's going to happen over the next 10 to 20 years, the kind of trajectory that we're on.
Yeah, we're going to have to see. Michael McKee's going to join us here in about 10 minutes, and we'll do the usual econobabble on CPI. But we thought, and this is a real treat for us, it could be a 3-hour conversation with Jonathan Miller. He's president and CEO of Miller Samuel. And all you got to know is when he wanders down Madison Avenue and he goes in three guys up by the Carlisle, the place comes to a complete halt. He is the most important person on real estate in this New York City, and I might add Miami and the rest of the country as well. Do we have a housing crisis in America, and do we see it in an inflation in housing that's 30% of the statistic we're going to see in 10 minutes?
Absolutely. It is a crisis. It's a crisis of affordability at all levels. If you think about the Fed pivot a year and a half ago, it's probably had a disproportionate impact on housing because mortgage rates are such a big driver of the housing market itself. Markets like New York are sort of, it's cash or, 60%, almost 2/3 cash buyers. But those cash buyers are still looking at the financial markets. It's not that they're not impacted by rising rates. They're impacted by Fed policy. And as a result, what we've seen is a sharp drop in sales over the last year and a half, both in cash sales and in finance sales. Cash sales are down about 20%, and finance sales are down between 40 and 50%.
Let's dovetail this into 9 minutes from now when we get CPI and we get the sense of inflation. How do you see rents and home ownership just generally feeding into the inflation narrative next year? Do you think that it is going to disinflate or reinflate some of the discussions?
I think the rental market is going to probably continue to disinflate, using your parlance. They've peaked. They peak in the summer seasonally, generally, in New York anyway, and we're seeing rents come down, but they're coming down nominally. The opposite of rising rents, as I've told you before, isn't falling rents, it's stabilizing rents. And I think we're looking at rents lower than peak, but not low, meaning that affordability is not materially improved.
Some people would argue that for rates to go back to even close to where they were before the pandemic, you would have to see a real decline in house prices. You'd have to see a real material shift in one of the biggest costs for Americans. Do you foresee that anywhere on the horizon?
No, simply because inventory is at, closer at all-time lows in many of the markets most of the markets around the country. That is the housing metric that has been the story.
Help us here, oh wise one. We're going to get this report in 7 minutes. McKee's going to go month over month, year over year. We're all living, our listeners, our viewers are living pre-pandemic. You have published the Miller rent inflation statistic is we're up 30% since pre-pandemic, since 2019. How long is it going to take us to lose that pain?
I would think 2-3 years, even with rate cuts. I think it's a while. Rental markets have momentum of being sustained at a very high level for a long period of time.
So we're going to be miserable here, seriously. I'm not making a joke, folks, till 2027.
I would think so. There's not going to be, at least based on what we know now, there's not going to be a rental price or purchase price correction. Unemployment is too low. Wages are elevated. It's hard to imagine. I mean, if you look at a Fed rate cut in the second half of 24, that's a year from now. So, and that's not going to change overnight. One sort of positive component to this is I think that any kind of rate cut on the set for sale market is going to have a disproportionately high reaction in terms of sales activity, that there's some sort of the rate pivot interrupted what was this rocket ship of demand. So I think any minor cut is probably going to, we're not talking going to 4 or 3% at all. What we're talking maybe going in the 6s from the mid 7s.
That's enough to grease the wheels?
I think that's enough to grease the wheels, at least in the near term. Remember, right now in the most suburban markets, we're looking at bidding war market share of 40 to 50% of closings.
Are still in a bidding war?
Absolutely. We had a lull in the summer. The suburbs that surround New York you're looking at 40 to 55% of the closings in the third quarter were bidding wars.
Could you see John, out in Larchmont or, up in
Bronxville?
Bronxville.
I look in Bronxville all the time. There's no supply.
you know.
There's no supply, Jonathan, coming online at all. It's the same old houses.
It's much tighter in the suburbs than it is in the city. If you're to buy, I'm not saying it's more affordable, but the city relative to most markets, because it was late to the party, actually has more supply. It's just still not.
You know anything in the 60s, 70s for John? He's, you know. We're out of
figure this out.
Evidently, he's looking at 5 houses north of the city.
Based on TK's track record.
I feel like that's the only reason I'm brought on is to give you house hunting advice.
You got that right. You figured it out. Good, John Miller nailed that.
John Miller there of Miller Samuel. John, it's good to catch up. It's good to see you. Thanks for the clarity.
Good to see you.
The clarity on the housing market in this country, which is a difficult one for a lot of people I know. Coming up shortly, we'll get some CPI data in the next hour on Bloomberg TV. Aaron Brown of PIMCO, Robert Tip of PGIM, Gagi Chowdhury of BlackRock, all of that and more. Mike McKee breaking down US inflation. Coming up next from New York, this is Bloomberg.
Worldwide, Bloomberg surveillance on radio and television. We are commercial-free through the rest of this hour. An important inflation report. Lisa, we say this every month, but all of a sudden it's superseding the jobs report. Is what matters for markets, what matters for the Fed.
And how does the market respond to a potential stickiness to inflation that everybody is expecting for an inflection sideways at 4.1% year over year at a time, where the Fed is looking to get down to 2%?
Coming out in real time with an immediate lift to the market, 8, 9, 10 lines on ECO Go on the Bloomberg terminal. And of course, Michael McKee is here to tell us how much it's going to cost to stagger to the end of the year.
Less. And that's the good news. It's a rather amazing number this morning. CPI comes in flat. The estimate was 1/10, and it had been 0.4 back in September, and that leaves the year-over-year headline number at 3.2%, down from 3.7. The forecast had been for 3.3. But here's the big number: core 0.2. It rounds down to 0.2 from 0.3 last month, and that's a tick below what we anticipated, puts the year-over-year number at 4%, and that's down from 4.1%, which was expected. There was a feeling that we might see a stall in the numbers this month. You guys mentioned that, and it has not happened. Inflation not as sticky this month. It goes down, gives the Fed a chance perhaps to say we don't need to raise rates in December, and we'll probably see a market reaction to that effect.
I see 40 pages on your thing. Dive into a couple of those key paragraphs, Mike McKee. Lisa, markets moving, equities surge. We've got to begin to talk about taking out record highs. Not this moment, but there we are with SPX up a solid 1%, 4475. We may get 4,500 there. The Dow, we're not to 35,000. We may get there in time. NASDAQ up 1.6%. 16
basis point plunge in the 10-year yields. I'm looking right now at 2-year yields, absolutely tanking above 5% before this, now down to 4.87% just in real time. People shifting downward their expectations for how long the Fed could remain on hold. They are celebrating signs of disinflation that they were not expecting from this report, Tom.
Dollar weakness, but critically, the 10-year real yield. I'll have to get the chart out while Mike's giving us an update on the 10-year inflation-adjusted yield plunging down 14 basis points, as Lisa mentions. 2.18% on that statistic. It was 2.50% the last time the Denver Broncos lost. Mike, what do you see in inflation?
Well, the things that people have been watching closely have turned out pretty much the way they thought they would. We saw gasoline prices drop by quite a bit, by about 5% during the month, which really pushes down on inflation. But fuel oil also down 5%. Food up only 0.3%, food at home at least. And then shelter costs, we're always looking at what's happening with shelter, and we'll break that down a little farther, but up by 0.3%, so not as much. Transportation services up 0.8%, so airfares probably went up. Medical care services, I have to break this one down for you. That was in the news. It's up 0.3%, which is probably less than anticipated. Here's the thing: the government once a year recalibrates
the autumn adjustment.
Health insurance.
Right.
And this month is that month, and the estimation was that they would show a big increase in health insurance, and I got to look deeper into the tables to find out.
Well, you do that right now. Lisa, bring us your insight. I want to make clear, folks, international ramifications on this report. Futures up a ginormous 53. Lisa, euro-yen is weak yen through 163, the knock-on effects on the far side of the world.
What I'm looking at right now is real average hourly earnings, which actually ticked up. And this I find interesting, to 0.8%. Basically, people are getting wages and they have more buying power.
Less inflation.
Because there is less inflation, which raises this question: can we hold? Is this going to be a temporary disinflation, or is this something that we can really hold on to? And that's what I want to hear from you, Mike, as you parse through all of the specific data points. Does this feel like a sustainable trajectory downward that is in response to people protesting some of the higher prices, not necessarily going with them, and that has some momentum behind it?
Well, I got to look, Lisa, here to see if I can see what refrigerator prices are doing.
Please.
But obviously, you're not protesting. And the thing, and we'll see tomorrow more with retail sales, the thing is Americans are protesting inflation, but they don't seem to be doing anything about it. I mean, it's a verbal protest, but they're not staying away from the stores, which has been good news up to now. So the question is, do they continue to do that? Health insurance, here we go, Tom, down by, no, actually rises 1.1%, but down 3.5% last month. So essentially what we're seeing here is a rise in health insurance offset by other things, and that seems to matter. Rent of shelter, you're talking with Jonathan just a minute ago, up 0.3%. Rent of primary residence up 0.5%, which is his story. And then the owner's equivalent rent up 0.4. It was up 0.6 last month.
So it's up less.
So it's up less, and that may be the big contributor given the size of housing.
You mentioned 30% to me, the size of housing. And Michael McKee, thank you so much. Let me reset right now on Bloomberg Television and Radio for you. Markets seizing up here, just huge moves. As Lisa mentions, in the bond market, 14 basis points, 4.50%, stunning. 4.50% for the 10-year. The 2-year was 5.04 the last time I looked, 4.90. Yields plunge, fixed income prices up. Equity surge, SPX up 51, Dow up 300 points in the Dow. And the VIX, Lisa, under 14, really says it all, 13.99.
What a long, strange trip it's been, going from 5% to 5.5% in a couple of weeks on a 10-year yield. Is the Fed done? Is this basically what we're looking at right now? The all-clear sign for the Federal Reserve to have to do more. Jay Bryson, chief economist at Wells Fargo, joining us now. I ask that to you, Jay. Does this sound the all-clear for the Fed?
It does for right now, Lisa. I mean, these numbers are going to bounce around on a month-by-month basis. I wouldn't. Our view is that the Fed probably is done, but I don't expect Fed officials to be coming out just because of this one report saying, "Oh, it's all clear, everything's great out there." I mean, I think they're still going to continue to be biased to potentially tightening. We don't think that will happen, but if in the next few months these numbers kind of reverse and they kind of pop up and the economy expands at a stronger than expected expected rate, you could potentially see them going. But again, I think that's a high bar at this point.
This adds to signs that there is some sort of cooling, and this is the reason why so many people are talking about a soft landing, because you haven't seen the real cracks you'd expect ahead of a massive recession. Jay, do you think that that is an accurate categorization of exactly what we're seeing with prices not going up as much as people had expected?
Yeah, I think that's right. I mean, if we were still clipping along at a year-over-year rate on the core of a 5%, we'd be talking about the Fed hiking even more. And when you start to hike even more, that's when you have the problems. So the potential for a soft landing is still there. I guess what I'm a little bit still watching and concerned about is that the real Fed funds rate, the nominal rate minus some sort of inflation rate, continues to drift higher, and that's what matters for the real economy. And so I think the Fed's going to delay easing at this point. And so we may or may not have a downturn early next year, but I think the next few quarters, because monetary policy is going to remain restrictive, I think you're looking at headwinds on economic growth.
Is it mission accomplished? There's a comedy to that, a painful comedy for our geopolitics, our history, Dr. Bryson. But are we getting to a transitory point where this Federal Reserve can say mission accomplished?
Well, again, Tom, I don't think they're going to come out and say that right at this point. But, what I would say is the bar for further rate hikes is getting higher and higher at this point. Many of the members on the FOMC think they have done enough at this point. And, today's rally in the 10-year notwithstanding, we still have seen, relatively high long-term rates. And so there's a fair amount of headwinds on the economy right now. Again, they're not going to come out and say mission accomplished right now. They need to see a few more months of this before I think they feel confident in that. This is certainly a good start in that journey, but I still think you need to see a few more months of 0.2s before they say mission accomplished.
Lisa, mission accomplished December 12th, a CPI report before a December 13th Fed meeting.
And just to really echo what Jay was talking about, that the bar is getting higher and higher for them to go again. Evidently, the bar is getting a bit lower for them to cut rates. Fed-dated swaps are now pricing in the first 25 basis point cut for June versus July before we got this print. Jay, there is this issue of what we're going back to. Are we seeing a fast enough pace of disinflation to believe that 2% is very much in the horizon? You and your team have been excellent about the last mile of getting inflation down from 3% to 2%. How far along that process are we?
So, I don't have the numbers here in front of me, Lisa, but, I think if you look at the 3-month annualized change in the core, we're probably at 3.5% right now. So if you want to get back down to 2, what you need is a few months of 0.2s and even 0.1s to kind of get you there. And I think we're still looking at a number of months for that. We don't think we're going to be looking at that sort of number until the second half of 2024. But I don't know if we necessarily need to be 2% annualized for a few months before the Fed cuts. They're going to be looking forward, right? And if they are confident that things are really going to slow down, then they could start to cut rates, maybe summer or so of next year.
Dr. Bryson, thank you so much. The chief economist of Wells Fargo, Jay Bryson, this morning. Mike, you're diving in. The reason McKee does this, folks, and I don't, is the font is this big. I couldn't even see the page like you can. In that teensweeny font you're looking at, what matters?
Well, the interesting number that everybody has been following for the last 6-8 months is Supercore, which is basically core services less housing, and that comes in at a remarkable 0.2 for the month of October. That's down from 0.6 the prior month, and on a year-over-year basis, that puts us down to 3.7%. So a major change in the Supercore because of the drop, I guess, in the slower rising core numbers that we saw. And then Lisa, I'm sure everybody is waiting to hear this, including you. You're a winner. Appliances went down 1.2% during the month, and major appliances down 2%. So congratulations on your refrigerator purchase.
You get a house, and you get.
But this is what David Rosenberg would say. Every single little thing sums up. to where we are in price change.
Which really it leads to this idea of the soft landing that people are talking about, because real wages are actually increasing at an accelerating clip on the heels of this. How much are we getting a sense of the services versus the goods divide? Are you seeing services continue to go up even as you see the refrigerators and microwaves go down?
Well, I can call that up here on the Bloomberg model Ecan Go, which is a marvelous thing. And it basically gives us an idea of whether services and goods, core goods prices were up less than 0.1%, or services prices were up 4%. Now, those are both declines. So we're seeing a steady decline in both of those categories, but services prices we're still seeing increases. Interestingly enough, I looked it up now, airfares were down 0.9, and that was a category that people thought might be a little bit higher.
Quickly here, what does it mean for retail sales tomorrow? John Ferro was saying that seems to be more important than the shock report. Could we get a shock retail sales tomorrow?
I don't do enough of the math, Tom, to know if it'll be a shock report tomorrow, but the drop in goods prices is what really affects the retail sales report, like refrigerators.
Refrigerators is a good, not a service sector.
Right, and we're going to talk about refrigerators at 8:30 tomorrow. And so we could see it would show as a less of a gain because you're not including inflation in that, but there will be a separate category for Lisa Abramowicz refrigerators.
Michael McKee, thank you. And of course, his excellence through the morning here on radio and television. We welcome all of you commercial-free towards 9 o'clock on this bombshell inflation report in America. David Kelly will join us. We're going to get to Ira Jersey in 2 seconds. Lisa, your thoughts on bonds?
The volatility that we're seeing is just shocking to me. And the idea that you could see a 15 basis point decline just like that on the heels of a 0.1 percentage point difference in inflation highlights how tightly wound everybody is. That is my question. Right. Does this stick? Is this the beginning of the big bond rally that so many people, including Bob Michael over at JPMorgan Asset Management, have been calling for?
Joining us now, Ira Jersey, Chief U.S. Interest Rate Strategist, Bloomberg Intelligence. Ira, there's so many moving parts here in this jump condition report. I'm going to give you an open question. In the matrix, the mixes, the analysis you have off the Bloomberg terminal, what is the fixed income pair, fixed income statistic that matters right now?
It's really that this is all from real yield. So this whole rally is not coming from a reduction in inflation expectations. It's all coming from expectations of the Federal Reserve, right? So when you look at what tips are doing versus what nominals are doing, tips are just driving everything. So, Lisa mentioned, is this the start of the rally? I think if this was the start of the rally, this would have to be the continuation because obviously yields were a bit higher not just a couple of weeks ago. But at the same time, you now have people starting to price for the Fed to cut earlier. You have real yields coming much lower, which is just a sign, I think, that people do think that there's going to be a soft landing here. And I think that the market is just reacting and maybe overreacting a little bit to these data.
What is the character in a December 12th report that has a 3.x handle on it versus 4.0 handle? How does that change or endure the bond world?
Yeah, so I think that continues a little bit of what we've seen today, where you have the belly of the curve, the 5-year part of the curve, rally a little bit more than the rest of the curve, primarily because if we do get another data, if we get a 3 handle on inflation, like you mentioned, Tom, then you're going to have the Fed on hold, if not the Fed, cutting rates earlier. At least that's what the market will price. And I think the big thing is, and the big reason why you're seeing these moves in the bond market is just the expectation now. Number one is data like this certainly takes another hike off the table, at least for now. And then if you do get that 3 handle on core inflation, then the Fed will be pretty comfortable in just saying, okay, we're going to leave rates where they are until we see inflation come down even further, but we're not hiking anymore. And I think today's move is an acknowledgement of that.
Ira, given that, why do you think that the market right now is overreacting?
Well, the liquidity is just not particularly good in the market. And it's not this time of year. It's the entire market. So you have a large stock of debt. Like we all know this, right? The deficits have been huge and they're likely to be big going forward. So you wind up having a situation where you don't have the capacity in the dealer community and in people who disintermediate and intermediate trades just can't take the volume that has to go through now. So you wind up with, relatively modest data like we have, and then people who are short need to cover. They wind up covering a little bit, and that little bit just can't go through the pipes the way that it has in the past.
Lisa,
so I think it really is all about liquidity.
Lisa, moments ago, and this continues, folks. This trend continues, and Lisa, you see it moments ago. Euro, 1.08. Weaker dollar, stronger core European holding.
And this all is tied to the Fed and the potential for them to not necessarily hike rates in additional time. Following on to what you're talking about, Ira, it's really important to highlight this lack of liquidity and the lack of conviction that some people have been having with some of the recent moves. This time does feel different if only you take a look at the Global Fund Manager Survey out of Bank of America, which showed suddenly people going long bonds in a material way. Why do you think that doesn't signify some kind of real money shift that could underpin some of these moves?
Well, it could. Certainly people want to be. I think people are looking for an excuse to be long, and certainly data like this is long. But at the same time, I think a lot of people are very cautious. So a lot of the investors that I've talked to have been burned earlier this year. They got long at around 4.25%, and then of course you had the sell-off in 10-year yields all the way up to 5%. So that was a pretty painful trade. So I think people are legging into these types of longer positions, right? And at the same time, if you think about the front end of the curve, and I think one thing that is attractive about things like 2-year yields is that in the next year, you'd need interest rates to go up to 10% to start losing money by buying a 2-year, right? So that's what we call the break even. So there is risk reward that people are trying to figure out, I think, about how much risk are they willing to take given the environment.
Look at the 2-year yield, 4.86% right now. Just extraordinary there, Lisa, to see this. All of these dynamics continue here as Ira Jersey speaks. Ira, one more. We've got to get to Dr. Kelly at JPMorgan. Lawrence McDonald, one of the essays of 2023, says, forget about the nuance. There's just a wall, trillions and trillions of dollars out there as a first order condition, a wall of money out there. How does the wall of money of the global system, Ira Jersey, react to this shock report?
Well, I think that people are still liking the fact that they can make, over 5% sitting in cash. And so, but you do have incrementally people who want to come out, because if the Fed is done, typically duration does pretty well. So you want to be long and want to take a price appreciation and, buy bonds that are, there are some treasury bonds right now that are trading 50 cents on the dollar, right? So some people might be saying, okay, look, I can buy some treasury securities here and, play that price return as opposed to just sitting in cash and making my 5% yield. But I think, again, that'll be incremental over time, not all at once.
Quickly here, Lisa, the first guy I wanted to hear from, Neil Dutta, and you mentioned the real income growth. We're seeing lesser inflation amid income growth. Mr. Dutta at Renaissance Macro, it's a soft landing nirvana.
And let's see how long that can last. Is this just the beginning?
There we go.
Of
There's the
else?
Bramble gloom we need here. We're going to get to David. Ira Jersey, thank you so much. Greatly appreciated. I really want to emphasize, folks, off of 830, the shock, maybe a pause, and then we continue to move higher. Futures up 56, Dow futures from 300 up to 337, the VIX under 14, and the right guest at the right time to advance this conversation. David Kelly will adjust. He's Chief Global Strategist at JPMorgan Asset Management. With his years at Putnam, knows when the facts change, he will change. David Kelly, how does your analysis change with this shock report? I got a technical issue there. It's the mute. But there you are, David. Start over again, please, David. We want to get that insight.
Yeah, so this report is actually very close to what we're looking for here. As we're tracing out inflation, we can see it coming right down to below 2% on the consumption deflator by the fourth quarter of next year. And I think what's really important about this report is there's a large camp of people who say that the last mile is sticky, getting from 3 to 2 is sticky. And we don't see that at all. We're going to step down inflation all the way through the fourth quarter of next year. And what I think this report is showing is across the board, there's disinflation in the U.S. economy, and we're heading back to 2%. And I think that is gradually changing the minds of the markets. And I think that's why you're seeing this move here.
Although it's not necessarily coming with pain, David, and this goes to the soft landing nirvana that Neil Dutta was talking about, that real average hourly earnings increased by 0.8%, up from 0.5%. People's earnings are exceeding the pace of inflation in a material way for the first time in a long time. How much does that lead to a stickiness because people have the means to keep paying the prices?
I don't think so, because we've had periods of positive real wage growth before. But what I'm seeing looking at the earnings reports from the last quarter is companies are very focused on holding earnings in check. Now, yes, you can say that today's earnings are higher than inflation, but from a worker's perspective, they're not even getting catch up from all the inflation they saw over the last 2 years. So what you're seeing is partial compensation for previous inflation. But I don't see a lot of evidence that companies are being able to push higher prices, the workers being able to push higher wages. So overall, I think what we're not seeing a price wage spiral. We're seeing a price wage slinky. They're both gradually coming down the stairs slowly. I think this is just going to continue all the way to 2%.
And there's a question mark around, yes, this is definitely good for bonds, and you're seeing that rally in a massive way today. Is this necessarily good for stocks over the longer term if it is accompanied with a cooling in the economy?
Yeah, I think it is. Now there are things that could go wrong, and there's certainly parts of the stock market that are overpriced. But I think what's happening is we're returning to where we were 10 years ago. We're returning to an economy with 2% inflation, very slow growth. That low inflation can allow for lower long-term interest rates, which supports all asset prices, bonds and stocks alike. And of course, stocks are the ultimate long-duration asset. So they will benefit from this lower rate environment. So, soft landings never last forever. They'll eventually be bump in the road and we'll fall into recession. But for right now, this does really show that inflation is steadily coming down, and we've got to recognize that's going on, regardless of Fed officials who occasionally say that we're not there yet or too early to declare victory. Look, I'm willing to say we're going to win this thing. It looks very, very likely that we're going to win this, get inflation down to 2% by the end of next year.
Small stocks, Russell up 4%, NASDAQ up 1.8%, though NASDAQ 100, I should say. Dow lags up 1.1%. Standard & Poor's 500 up 50, up 55, up 60, and now up 63 points, 1.5%. Dr. Kelly, I want to sum this up to the angst that Lisa Abramowicz has on our nation's debt. If we get inflation down, if we have a successful Fed, does that give you confidence that we can have a long-term R minus G relationship, R minus G equation that will mean our debt and deficit is of less fear?
A little bit. I mean, what you're basically saying is we can service this debt at cheaper prices, no matter how large it is. Yes, we can to an extent, but I think the amount of debt we've piled up in recent years is going to mean permanently higher long-term interest rates than we experienced 10 years ago. So that problem is going to be around for a while. And unfortunately, I see no evidence that there's any consensus in Washington about doing anything about it. So I'm still worried about populism on the left or the right just pushing these deficits higher and higher in the years ahead.
Dr. Kelly, thank you so much. David Kelly, JPMorgan. Lisa, I'm going to say this. I could be wrong. Everybody will come out with analysis better than me. I've never seen this. It's just that simple.
We are seeing a kind of rally in bonds, especially coming off some of the discussion from Bank of America that indicates a shift in mood. That Fed basically is off the table in terms of another rate hike, that rate cuts are being brought forward in market expectations. And people right now, as we just heard from David Kelly, are saying we are going to win this thing. There is a feeling maybe this is not an inflation that can lead to 6, 7, 8% Treasury yields. That discussion, for now, is off the table, Tom.
4.48%. Let's want to, Lisa, help me here with a data check as we close out this hour. I'm going to look at a 2-year yield, 4.87%, distant from 5.04. Truly a cup of tang ago.
That's the right yield to look at. I'm also looking at a 10-year yield down to 4.48% from near 5% not that long ago. Massive rallies across the curve, and you could see that dollar weakness, euro strength, 107.91.
Stay with us on radio and television through this shocking day. Ken Griffith in the 1 p.m. hour. Good morning.